In London with Tom McKenzie.
And here are your top stories. Traders await Fed Chair Jerome Powell's testimony on policy. JP Morgan's Jamie Dimon says inflation is not beaten yet. Europe looks set to open lower. China's new foreign minister signals tensions with the US threaten to entrench divisions between the world's two biggest economies. Plus, Meta said to be planning thousands more job cuts on top of the 13% reduction in November to become more efficient.
Tom, let's take a look at the futures. Now, for the moment, they're pretty much undecided, I would say. That's probably the polite way of putting it. If you look at the Euro Stocks 50 futures, they're down 0.2%. They're waiting for Jay Powell. And, of course, they're waiting for more clues coming out of China.
Yeah, a bit of a holding pattern, as you say, ahead of that important testimony from Jay Powell. What will he say? Will he keep the door open? Will he open the door, in fact, to a 50 basis point hike? That would be a key risk for these markets. Will he say, in fact, that the Fed continues to be guided by their original dot plots that came through in December? The market now pricing in around 5.5% for the terminal rate, above, of course, the top end on the dot plot. The markets then, as we check in this Tuesday morning, the Spanish IBEX currently just off by 5 points. The FTSE 100 is range-bound. Iron ore and basic resources have come back after dropping yesterday on concerns around China. The CAC current over in France is also flat. When it comes to the Fed, we've talked about the testimony from Jay Powell. The ECB, though, the divisions there are just becoming more acute. And we heard this from Holtzman of the Austrian Central Bank, of course, a board member of the ECB as well, saying he wants to see 4 50 basis point hikes coming through from the ECB. Clear divisions within the governing council then as to the future of the hike direction. Futures in the States pointing just modest gains of 0.1%. Euro dollar 106 has been at that level now for a number of days, unchanged really for the single currency. In terms of the 2-year, of course, most sensitive to anything that we hear from the Fed and Jay Powell, 486 on the 2-year, just a move of 2 basis points. And Brent, $86 a barrel, just a gain of 0.3%, Fran.
Tom, let's also dig deeper into some of the sectors that are on the move. So, of course, the European Stock 600, we have 20 industries on the move, and about 5 are up. Energy leading the gains, 0.5% higher. Retail, healthcare. And then on the downside, I have technology probably on the back of that meta news that they're laying off quite a lot of workers. Telecom, auto parts, and media all on the way down, Tom.
Okay, now JP Morgan's CEO, Jamie Dimon, says he sees trends remaining in terms of the inflation picture. He spoke to us exclusively.
We can still have a soft landing. A mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Jamie Dimon there speaking exclusively to Bloomberg's Ed Hammond on the sidelines of the JP Morgan Global High Yield and Leveraged Finance Conference in Miami. Now, across the Atlantic, ECB officials divided here over just how much to tighten. For more detail, our markets reporter Valerie Teitel joins us with the latest. Valerie, it's Hawks versus Doves once again. So what's the latest?
Look, the Holzman comments were very notable yesterday. I want to go through a few of the things he said. He called for not just 2 50 basis point hikes, but 4 50 basis point hikes. That would take the terminal rate to 4.5%. He also said, in his eye, the neutral rate is at 4%. The current ECB depot rate, Francine, is at 2.5%. The ECB has a long way to go. He also had a comment on QT. He was a fan of increasing the QT pace points in the fall. Now, we also heard from some of the doves yesterday, that being Lane. He's pushing a more dovish view, saying we should look more at the cumulative tightening effects. That's important for him, and he's against putting the policy on autopilot. Clearly, he doesn't want to promise more 50 basis point hikes than they need to. We also hear from another key dove tomorrow, that's Panetta. This is all leading up to the ECB decision next Thursday.
How did the markets react? Yields just coming in just very modestly in the session today, Valerie.
Oh, the markets definitely listened to those hawkish comments more than the dovish ones yesterday. The German two-year yield jumped 10 basis points after the close, into the close yesterday after those comments. The curve had this brutal bear flattening. It really stood out versus treasuries, because treasuries kind of had the opposite move when these comments came out. It strengthened the euro in the end. But we've seen also the sell side increase their ECB terminal rate calls. A slew of them last Friday upgraded to ECB terminal rate, seeing it at 4%. After the Holzman comments, Tom, it was notable. Nomura is now calling for a 4.25% terminal rate from the ECB.
Okay, there's the call from Nomura then, 4.25% from the ECB. Bloomberg's Valerie Teitel, thank you, on the squabbles within the Governing Council of the ECB.
And Tom, coming up, we also speak to the ultra-hawk Bank of England Monetary Policy Committee member, Catherine Mann. Don't miss that interview at 9:30 a.m. UK time. Let's broaden out this conversation. European bond sales topping €500 billion since the start of the year, the fastest pace on record. Now, for more, we're joined by Bloomberg's Christine Aquino. Christine, good morning. So why are companies and governments actually selling bonds like never before?
Well, Francine, I think what we're hearing from these companies is now is as good a time as any. They're citing that there is a lot of uncertainty coming through in the pipeline for 2023. We don't really know whether we're headed for a hard landing or a recession scenario. Maybe we avert it and see a soft landing. But regardless, companies know what's happening right now. They don't know what's going to happen in the future. And they think that now is a good time to sell while they still have a good handle on the broader macro picture of inflation and growth.
Right, so that's part of the rationale, clearly, isn't it? Even in the face, as you say, of higher yields. This is the appetite for companies in that environment. They want to make sure they have the liquidity coming into the business. Is that the key rationale at this point?
Absolutely, Tom. And I think also part of the broader environment right now is that investors are willing to buy bonds because they finally yield something after years and years of near zero or even negative yields in the case of some of the European government bonds that we've seen. And so there is this renewed appetite for bonds, whatever function they have in your portfolio, either as a hedge against stocks or a store of wealth and value. But what we are seeing at the moment, you're absolutely right, Tom, is that companies are having to pay up to provide investors that attractive yield. They have a lot of competition, especially from the shorter end of markets at the moment. We're seeing massive yields there, and there's a lot less duration risk in that part of the curve. And so if these companies really want to compete with that part of the curve, they're really going to have to pay up in terms of yield. But investors at this time anyway are willing to snap it up.
Okay, Bloomberg's Christine Aquino, thank you very much indeed for that huge issuance we're seeing across Europe. Let's bring in Patrick Armstrong now, CIO of Plurimi Wealth. My apologies, Patrick. Thank you for joining us this morning. Mike Wilson over at Morgan Stanley is saying that this bear market rally has further to run, but ultimately the storm clouds are building, that we will hit a stormy patch in the medium term. There's going to be further downside. Does that echo with your views at this point?
I'm not so sure. I think equities are probably going to be higher than they are now at year end. I think it's going to be a real divergent in a path that they get there. I think the highest multiple stocks still have frothy valuations. They have air pockets to get out of them. It was a real liquidity-driven rally in January, and I think you've started to see that subside. But I think the companies that are producing cash flow today, companies that are able to defend their profit margins, I think the market's going to reward those kind of companies. And I think overall, you'll have more of those kind of companies than the high multiple stocks that are really going to suffer this year.
So, Patrick, first of all, where do you see a little correction? So you say, pockets of correction in the markets.
Well,
is it regional or is it really industry-wise?
I think it's almost everything that's really suffered in 2022. I think you've got another leg down in 2023. So the no earnings technology companies, I don't think there's a business model in place for most of these companies that they have a path to profitability, and they're dependent on negative real yields, liquidity, selling the dream. But there's real alternatives out there that are going to suck capital away from those kind of dreams. They're just on a 6-month treasury getting over 5% now, value stocks that are producing a lot of cash flow. So those are the stocks that are most at risk. and also the low-end consumer. They have no ability to defend their margins. So high-end luxury consumer, very well positioned if you're selling into them, because mortgage rates, food prices, energy prices, they don't hit the luxury consumer. And also input costs don't matter to Hermes when they sell a scarf for $2,000 if rising prices are nothing as a part of that profit margin. If you're selling mass market, if you're a Tesco, if you're a Home Depot, small changes in input prices, selling to a consumer that's strained, that's going to be difficult.
So that's the input price component. What about the rates component? 5.4%, 5.5%, that's what the markets are pricing in, well above the dot plots of, 5.25%. Does that view hold in the context of a 5.5% terminal rate from the Fed?
Definitely holds. That's the thesis is behind it.
Right.
Is basically higher interest rates kill long duration. So companies that don't have earnings today, you're paying for future earnings. When you have to discount that at a higher rate, you've really got to punish those multiples. Companies that are producing cash flow today, you can get rewards.
Do you think we get to 5.5?
It's looking like we will. I didn't think so coming into the year, but I was expecting 5 would be as far as they got. But you've had a really strong European economy. You've had China unequivocally opening up, and that's created a tailwind for the global economy. And the U.S. consumer has been so resilient. So I think we get to 5.5.
5.5 with inflation at what?
I think inflation is on a downward trajectory. I think the central banks will be comfortable if we're getting around 4%. They've got a 2% target, but I think the sweet spot for their governments and central bank policy and most consumers is that at a 4% inflation, we don't have to do anything to kill it off at that point. People can live with that. So I think that's the unmentioned target. We're on a path to get there. You can do it without creating a significant recession just by slowly hiking, getting a little bit past neutral. And I think 5-ish is probably neutral. We are getting into restrictive territory soon.
Does the division within the ECB, does it concern you? Is there an increased risk of a policy misstep from the ECB given these entrenched divisions?
Yeah, some of the sound bites yesterday from the ECB about 450 basis point hikes. If you look historically, almost every recession has been created by central banks that got a little bit too panicky towards the end of the cycle when inflation was high and they thought they still had a lot more to do, but already the economy was rolling over. And I think if you had another 450 basis point hikes, that would ensure probably a very significant recession. So it is something to worry about. Most recessions are caused by central banks that are basically chasing what previous mistakes they made.
Patrick, are you worried that actually companies are giving so much back to shareholders in terms of dividends or share buybacks that they're just not investing enough? So they're just delaying the problem 2-3 years?
But investors have the ability to put that to work in other places where they are getting higher returns on capital. If management aren't seeing good places to deploy the capital, they should give it to shareholders. And I think that is a way to reward shareholders, dividends, force cash flow to shareholders, share buybacks led to investors who want to sell and create cash, make that decision for themselves. And you're seeing more allocations to private equity, other higher growth areas potentially as well. So it doesn't worry me at all, actually.
Patrick, thanks so much. Patrick Armstrong, Chief Investment Officer of Plurimi Wealth, stays with us, and we'll delve a little deeper in some of the stocks that he likes or doesn't like. Coming up, Meta is also said to be planning thousands more job cuts on top of the ones already announced. So we'll explain what's behind the move next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. We are 14 minutes into the European trading day. You're seeing modest losses of about 0.2% across the European benchmark. Futures, though, holding to gains in the US. The Nasdaq futures up to 0.1%. ESA, S&P E-minis up 0.1% as well. Bit of a holding pattern then ahead of Jay Powell's testimony in the Senate. When it comes to yields, just coming off marginally across the US Treasury curve, Fran.
Now, sources have told Bloomberg that the Facebook and Instagram parent company Meta is planning a fresh round of layoffs. Well, Bloomberg's Sue Keenan has more.
This would be the second round of layoffs for Meta in 4 months and is driven by an efficiency push, according to people close to the matter. This is what Mark Zuckerberg, the CEO, has dubbed the year of efficiency. Sources close to the matter are telling Bloomberg that thousands of employees could be cut as soon as this week and that this latest phase could be finalized by next week. So it's a fast-moving development. The layoff is on top of a 13% reduction last November, and another round of layoffs had been widely anticipated. Bloomberg reported back in February that the company has also been working to flatten its organization by not giving buyout packages to managers and cutting whole teams that it deemed non-essential. We're being told by sources currently that the imminent round of cuts is being driven by financial targets and is separate from the move to flatten. Big picture, Meta stock has gotten a bounce from the layoffs and efficiency moves and is up some 54% year to date. Sue Keenan, Bloomberg, New York.
Okay, let's bring back in Patrick Armstrong, CIO of Plurimi Wealth, on the view around technology. Bad news for employees in terms of these job cuts, good news for investors?
Probably, and I think it echoes what we talked about in the previous segment, that companies, the stock market rewarded them for growing, attracting users, not generating profit necessarily. And I think Facebook or Meta has acknowledged now that it's more of a value company than a growth company, and focusing on the bottom line, creating efficiencies. Those are value company techniques to create shareholder value. And I think that's what Meta is being forced to. But overwhelmingly, the tech sector is overhired, basically, to achieve that growth that the market was rewarding. There's probably more redundancies coming from all of big cap tech going forward.
But Patrick, this is redundancy also because they're expecting a downturn, or the way we consume things changes, or because they just got too bloated?
Yeah, I think it's both. They were on a secular growth path, and now they're on a cyclical growth path. So a strong economy impacts their revenues now, whereas in the past it was attracting new users that impacted their revenues. They've reached saturation, and now the economy is a big headwind or tailwind, depending on how it's going for these companies. So they do have to adapt to the cyclical environment, but they also have overhired, probably expecting that secular growth would continue for longer than it could.
You have holdings in Alphabet and Amazon. You've pointed out that they...
I have Alphabet and Apple long. I'm short Amazon.
Short Amazon. Okay, Alphabet and Apple. You talked about how Alphabet weighed on your portfolio in the most recent month. Why do you hold on to that position?
The market was pretty underwhelmed by its competition that it's laying out for ChatGPT, and I don't think that's really going to move the dial for them. I do think they have a lot of capabilities. They've spent billions there, and I think it was probably a poor presentation rather than poor technology. So I'm not giving up on it. It's still got the dominant market share. It's still the best place to advertise if you want to advertise online. So it's a company that also, like Meta, it's not trading at a premium to the market anymore. I think it's got the dominant position in its industry. It does have recurring revenues that are very strong, so I don't mind paying a market multiple for that kind of company.
But Patrick, is there something that ChatGPT or something like that will not disrupt?
Yeah, I thought it was almost undisruptible a few years ago, but it does seem this ChatGPT does create the potential for it. And I do think it has competing technology that'll match it, but yeah, that's a risk. And I think that's why you're not seeing it trade at the lofty multiples at the high 30s. We're down in the teen multiples for it now. And I think that's a fair price for a company that's still producing a lot of cash flow, still has very good growth potential, but it's not going to be in a monopoly position going forward.
Patrick, the high rates environment, the impact on the financial sector, the financial services sector, what have you been adding there? Are you adding in that space? Is there further upside?
I've added BBVA in January, and that's been really good. I was even shocked by their report to the regulator that they expect 23% revenue growth this year, and I think that's a conservative estimate when you're filing something with the regulator. You don't do it to brag. So that's showing the strength of the banks in Europe, that all of a sudden, instead of having to pay the cash they have as deposit, now they're receiving money from the ECB. So that's going to be a big tailwind for revenues and profits.
What's your take on Infosys? So this is something that you actually bought more of.
Yeah, we bought that just recently in January as well, I think. So that's consulting technology. It's trading at a 20 multiple, bit of an exposure to emerging market, play on India as well. So it's, as we've shorted Amazon, we wanted stocks that are in technology that aren't trading at the multiples that Amazon is and not selling to a consumer, selling more to businesses that have a lot of cash flow to spend on these kind of services.
How much do you want to lean into duration in terms of fixed income?
I don't want any, really. The shorter the duration, the better. That's where the curve rewards you. You get paid more to be shorter duration, and it's a risk to be longer duration. So if we're not falling into a recession, the longer part of the curve has to rise. So you've got an incredible amount of backwardation in the curve right now, that you've got the inverted yield curve. That's indicating people are expecting the recession. If that doesn't come, you have to see that flatten out. So I think duration will get punished in that environment.
Patrick, one of the other themes, and we're looking at this morning, is agribusiness or the agri-business. Is that a China play?
That's a play on companies that can defend their margin. And you've got China increasing meat consumption from Chinese, and you've got 25 kilograms of grain are required to produce a kilogram of edible beef. And you've got this multiplier effect as people move and increase their protein consumption in China. You've also got global warming creating droughts in some areas, floods in other areas, disrupting harvests, so you see very high grain prices. And you saw that in John Deere's results. Farmers have lots of money. They're going to farm every acre of arable land they have. And that's going to lead to companies that are selling into these farmers that are cash rich, being able to defend and grow their margins. So that's one of the sectors we like this year.
Patrick, I want to tie it back to the top conversation around inflation, because you have a line in your notes to us talking about inflation, the impact of populism and protectionism in developed markets in the developed world. And I know this is a story that really grabbed Francine's attention as well, which is a story around California and taking action around Walgreens Boots because they've decided to stop selling abortion pills in some red states. And of course, the interest being, and Francine was flagging this morning, is that what that means for investors more specifically around the divisions, the entrenched political divisions, as you look to different states, different governors, blue and red, taking action against different companies, whether it's Walgreens Boots or Disney in Florida. How much of a challenge is that?
It's a challenge. It's not something we've dealt with, but there does seem to be creeping government overstep, and it is an issue for businesses. I don't have a big answer to this very big question at this point, but it is something that I've been noticing as well.
But Patrick, could it actually change the way or what companies you buy depending on a political stance on something?
Yep. You have to adapt to forces that impact the profitability of companies, and if the companies push back and win and say this is where the government shouldn't go, that's probably the best scenario for equity investors. But there is overstep by governments trying to push morality on companies, push their points of view on companies, and it is going to have an impact on valuations and growth potential.
All right, Patrick, thanks so much. Patrick Armstrong, Chief Investment Officer of Plurimi Wealth. Now, let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Goldman Sachs is losing star stock trader Joe Montesano. Bloomberg understands the 46-year-old recently told the firm he's stepping down as head of equities trading for the Americas, but is yet to line up another role. Montesano has been key in Goldman's ascent to the #1 spot in equities for the past 2 years, with total pay that rivaled CEO David Solomon's. Halifax says UK house prices rose at their quickest monthly pace since June last month. According to the mortgage lender, prices gained 1.1%, the second increase this year. The figures mark a sharp contrast with rival Nationwide, which says prices are now falling at their fastest annual pace since 2012. Australia's central bank has signalled that a pause in its 10-month tightening cycle is in prospect. The RBA lifted its cash rate by 25 basis points to 3.6%, the highest level since 2012. Governor Philip Lowe says the rate path will depend on incoming economic data. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Laura Wright. This is Bloomberg Tom Francine.
Laura Wright here in London. Thank you very much indeed. Coming up, we're going to speak to the Bank of England Monetary Policy Committee member Catherine Mann. Don't miss that interview at 9:30 a.m. UK time. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back. Broad European markets just changing and moving into the green, a little bit more upside coming through. Let's check in some of the individual stocks, though. Some big news when it comes to Carlsberg, the CEO announcing unexpectedly that he will be stepping down in the third quarter. At the latest, the shares taking a hit on the back of that. We're not seeing Carlsberg at this point. John Wood Group, this is gaining, look at that, 14% as they push back and say Apollo needs to up its bid for that engineering company. HelloFresh taking a hit, down 7%. The earnings are missing in terms of the outlook as well. Disappointing for investors. Ashtead getting 2.7%. That is on the back of rental revenue forecast for the full year coming in higher than estimates.
HelloFresh, we need to talk about HelloFresh. But up next, we also talk about China warning the U.S. about tensions. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Markets tread water as traders await Fed Chair Jay Powell's testimony on policy. JP Morgan's Jamie Dimon says inflation is not beaten yet. China's new foreign minister signals tensions with the U.S. threaten to entrench divisions between the world's two biggest economies. Plus, Meta set to be planning thousands more job cuts on top of the 13% reduction in November to become more efficient. So, Tom, if you look at the markets, they're kind of, what are they, treading water, waiting for U.S. payrolls and Jay Powell.
Yeah, exactly. There's been a bit of a turnaround in sentiment. It's very modest. So we're back in the green now. We started off on the downside in terms of the broader benchmark across Europe. Currently gains of just 0.1%. But absolutely right. Focus, of course, on what we expect to hear from Jay Powell. Is he going to address that gap between the market pricing of 5.5% in terms of the terminal rate and the dot plot of 5.25%, which was back in December? Is he going to address that gap? Is he going to open the door, even possibly to 50 basis points come the next decision at the end of March? This, though, is what Mike Wilson over at Morgan Stanley would describe as the bear market rally. He thinks it's got further to run, and then the pain will be felt in the medium term. The DAX currently up 0.1%. Here in the UK, 7,932 on the FTSE 100. The broader benchmark at 464, just a gain of about 0.1%. Banks gaining 0.3% is the move higher across that sector. Healthcare also in the green by 0.3%. But again, it is very modest. About half the sector's in the red at this point, led by technology down by 0.5%. Francine.
Now, JP Morgan Chief Executive Officer Jamie Dimon says Russia's war in Ukraine and U.S. relations with China are amongst his top concerns. Now, the boss of the biggest U.S. bank says it's up to the governments to consider their security priorities and policies.
The thing I worry the most about, if you go, is Ukraine. It's oil, gas, so the leadership of the world, and our relationship with China. I mean, that is much more serious than the economic vibrations we all have to deal with on a day-to-day basis.
On the Ukraine question, look, we talked about it a lot, obviously, a year ago, very shortly after the war had started. Do you think now, a year in, that the West has become sort of somewhat inured to the idea of a conflict of this scale on its borders? And if so, does that worry you?
Yeah, no, it looks a little bit like people are inured to it, but I think that's a little bit of a mistake. I read a report the other day that when a war goes to 1 year, it normally lasts 10. But this is a major land war in Europe, in a free and democratic nation, with hundreds of thousands of casualties already on both sides. And so I think we don't know how this is going to end. We don't know what direction it's going to take, and it's affecting global relationships. So Ukraine, Russia, then it's oil, gas, food, how it's hurting poor countries, and it's roiling trade relationships between America, China, and the rest of the world. So this is probably the most serious geopolitical thing we've had to deal with since World War II.
do you foresee a future where JP Morgan could potentially re-enter the Russian market as a business?
I mean, I'm very premature to say. You know, I think if there was a one day, maybe, but it's very possible that won't happen in our lifetime.
And you mentioned U.S.-China relations, obviously not at their best right now, particularly post the balloons. I wonder what role you see business playing in trying to sort of moderate those relations and try and keep them as good as possible.
Yeah. Well, you know, it's really the government. The government has to set the rules and figure out what they want to do. And I think it's a fair complaint about government and business that we probably should have started resetting this 10 years ago. And we didn't. I don't like to cry over spilled milk and all that. But going forward, the government, and I think they're doing a good job thinking through what is national security. So think of semiconductors, rare earths, penicillin, you know, certain drugs. What is unfair trade? And then, you know, at one point, sit down and have a very serious conversation with the Chinese government. You know, remember, Secretary Blinken was on his way over there to do that, and then the balloon. But at one point, they'll do that, and business is a peripheral player in that. So I think business will help give advice on how to do things. If you're going to have outbound investment controls, how do you set that way that works? That's not just a huge bureaucracy. And so far, all the conversations have been quite rational about it.
I mean, JP Morgan obviously has a significant business in China. I'm sure that the government there would listen to you. What are the conversations you have just about sort of trying to, as I say, trying to maintain as cordial relations as possible between the two nations?
I mean, look, for us, we're there. And like I said, you know, we're basically taking a back seat to an American government in this one. And we obviously have to do whatever the American government asks us to do. And we're trying to engage in a conversation with our own government and with the Chinese government and what those things should be. You know, I'm hoping cooler heads prevail here.
Okay, Jamie Dimon speaking exclusively to Bloomberg's Ed Hammond then on the sidelines of the JP Morgan Global High Yield and Leveraged Finance Conference in Miami, ending with a comment there on what he hopes will be cooler heads prevailing in terms of US-China tensions. Let's stay with the China story then. President Xi Jinping is reportedly rallying China's private sector to establish technology independence and help overcome, quote, containment by the US and other countries. The new Chinese foreign minister, meanwhile, Qin Gang, has also spoken at the NPC conference this morning. He warns that Washington's approach towards Beijing is, quote, a reckless gamble that puts the two nations, and he says, even the future of humanity at risk. Joining us now for more is Bloomberg's economics editor for Greater China, James Mager, joining us from Beijing. James, what for you then were the key takeaways from the comments by President Xi and Qin Gang?
I think from Qin Gang, especially this morning, it was very clear that the government does not see any kind of possibility of a rapprochement or a sort of improvement in relations with the U.S. right now. He pushed back very forcefully against the U.S. stated policy with China, which is that they want to set up with the U.S. terms guardrails in the relationship so that, you know, things don't veer off course, but also that the U.S. wants to, you know, to use export controls and restrictions on technology to maintain America's, you know, technological and manufacturing lead with China. And, you know, basically Qin Gang said that those things are looking, you know, that's looking to contain China, looking to stop China's rise, and that is unacceptable to the Chinese government. And he said that the discussion about guardrails is just ludicrous. What he said was that it's the U.S. that is pushing the relationship, of course, and the U.S. can't force China to be within some sort of barrier or guardrails, however the U.S. wants to frame it. So it's very, very strong pushback, basically saying that whatever the U.S. thinks they can do to China, you know, China is not accepting of that, and China has a very different idea about how the relationship should be. And obviously, Xi Jinping was speaking to business. Sorry, go on.
No, I was going to say, James, at the same time, I think he hailed close ties between Beijing and Moscow. But going on to the data and the economy, they show that China's exports dropped in the first 2 months of the year. What can we read from this?
Well, obviously, the central banks around the world are trying to slow demand because inflation is too high in other countries, and part of that slowing demand is going to be slowing demand for Chinese exports. Chinese exports have been falling now since October of last year, so it's really no surprise that they continue to fall this year. What that really means is that the real growth driver for China's economy this year, if there is to be one, is going to have to be domestic demand. And that's part of what Xi Jinping was talking about. He was talking about a whole nation approach to push back against U.S. containment efforts, or what he terms U.S. containment efforts, but they're also talking about government and business working together to really drive the economy and to boost domestic consumption, specifically because export demand is weak right now. It's probably going to be weak for at least the first half of this year. And depending what happens with the Fed and the ECB and other central banks around the world, it could be weak for the rest of the year. So really, China has to set the pace for its own economy this year, partly because the rest of the world isn't buying from Chinese goods, and also partly because they see themselves being separated from the rest of the world by American policy.
James, we have some breaking lines crossing the terminal right now, some redheads that it'd be interesting to get your views on in terms of the context. One of the redheads, China to set up a national data bureau in part of a major government reform. I think this was flagged by some media yesterday. China also setting up an enlarged financial regulator to absorb the CBIRC, which is the regulator that oversees the banking and insurance sectors. This, of course, within the context of additional scrutiny from lawmakers in Beijing, particularly on the financial sector. What is your take on what we're hearing then, these lines crossing right now, James?
Obviously the government has already flagged, and the Communist Party has already flagged there's going to be a big reshuffle in who does what and who's in control of what during this MPC. So I think the data regulator is one part of that. Obviously, there's been this big discussion about who controls data around the world. The Chinese government was very reticent to see Chinese companies that had data on Chinese individuals go overseas, which is why the listing of Didi, the ride-hailing company in the US, collapsed. And so this data regulator, part of that, it looks like it's going to be controlling what data can and can't be exported from China. The other thing about the banking regulator, it's very unclear what this is going to mean. I was just looking at some sort of photographs of the new org chart that was circulating online just before I came on air. So all we have really at the moment is like this is the new organization. It's very unclear how that's going to work in practice or what sort of problems or issues has precipitated this change. Is the central bank going to be part of that or not? How is this going to work with the securities regulator? All these questions, I think, are still, at least when I came on air, were still unresolved. So we're going to have to see how that works out in practice. But there is a real shift happening from the state to the party in China at the moment. Obviously it's a party state, so there is, it's always a balance between those two things. But it seems like the Communist Party is taking much more direct control of specific areas of the economy: national security, domestic security, the financial sector, and it seems like data regulation as well is areas where the Communist Party is taking more direct control away from the state and what's called the State Council here, which is effectively the government and the ministries.
James, thank you so much for that invaluable insight. Bloomberg's economics editor for Greater China, James Maker. Now, coming up, the debt ceiling showdown is looming. We'll explain why financial markets are worried or are not worried yet, actually. This is Bloomberg.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
It's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
I think as you look at China, really the big item that's changed is the aspects of post-pandemic. And as you look at the energy demand and also the desire for energy, it's increasing and it's going back to the historical highs, which means you're going to see more being consumed in China. A 5% GDP growth also means there's going to be more consumption. And also you look at natural gas and LNG. China, during the course of last year, actually reduced some of the LNG cargoes. They went to Europe. We see that going back to China now. So overall, China is very constructive from an energy demand perspective this year.
So from that, are we going to see China compete with Europe for those LNG cargoes, or is there going to be enough to go around just all at higher prices?
Well, luckily we are seeing more capacity that's coming on stream, and we've got a number of projects. You know, if I said last year, during the course of 2 years, we'd have 100 to 150 million tons of FIDs. We are seeing that. We're on track for that. And as we look at 2030, there's still going to be a need for an installed capacity of 800 million tons. So, yes, there will be some competing going on for LNG cargoes, but we think over time that will actually balance out, and LNG is actually going very positive.
And FID, final investment decision, which is when you're actually able to get the projects done. We'll get to that in just one moment. So on that, if all of a sudden someone said, Lorenzo, I need this much LNG capacity, can you deliver it, or does it need to be just a higher price? Like, do you have the stuff to deliver, or do you just have to charge more to do it?
So we have the stuff to deliver. And again, LNG is not just any one type. There's different models, which can be actually a stick build, a modular build. And what we're seeing a big theme on right now is actually modular builds. And we've got our sites in Italy that have become very much module experts. And so we've been able to deliver modules that allow from FID to first cargo with 26 months.
Which basically you build it there, you kind of move it, you ship it, you plop it down, then you use it. Yeah. So talk about the inflationary part of that, though. How much are you going to charge for your services? You're in a lot of different kind of businesses. How sticky are these prices?
Well, we're seeing a constructive pricing environment, and obviously when there's a demand for the equipment and the services, it makes the outlook constructive. Again, we are competitive and we play in a competitive landscape. So, you know, our purpose is to be there and partner with our customers and make sure that these projects go forward.
Okay, that was the Baker Hughes CEO, Lorenzo Simonelli, there speaking to Bloomberg's Alex Steele at the CIRA Week by S&P Global Conference in Houston. Just a headline crossing the terminal, trying to get more details on this and context. Qatar's emir has apparently accepted the resignation of the Prime Minister Khalid al-Thani. Again, we'll bring you more details if and when we get them. Now, Bloomberg will be speaking to many of the attendees throughout the week at CIRA Week, of course, including US Special Presidential Climate Envoy John Kerry, as well as the CEOs of EQT Corporation, the Williams Companies, Trafigura, and Freeport McMoran. Be sure to look out for those as well.
Now, we're 4 months away from a potential devastating U.S. debt ceiling breach. Right now, Republicans and Democrats are playing a slow game of chicken, each waiting for the other to flinch. Now, financial markets are showing little sign of concern, but what if the unthinkable happens? Well, Bloomberg's Bill Ferries joins us now. So, Bill, I have to say, a lot of people we speak to are saying, look, this is a problem. We can't think about it now because they don't know how to price this. They don't understand how this is possible. So U.S. House Speaker Kevin McCarthy is in a tough bind right now.
Right. If you go back, I mean, it was only, I think, less than 2 months ago, Kevin McCarthy went through an almost unprecedented 15 rounds of votes to become Speaker of the House. And he had to make a lot of concessions to get to that job. One of them was that any single member of the House could call for his replacement. And when they did that, they had this debt ceiling fight in mind. He has to try to cobble together a majority that will pass some sort of extension of the debt ceiling without feeling like he's going to lose his job in the process. That's going to be a tough negotiation, and it's going to go very late into the process, I think, for most people in the markets.
Bill, just switching focus a little bit. California's Governor Gavin Newsom saying that the state is going to stop doing business with Walgreens Boots because they have decided, it seems, to stop selling abortion pills in some red states. What is the consequence? What is the broader potential impact on American business? We look at the Florida actions and the governor's actions there around Disney. We look at the pushback around ESG, investing, and now we have this, the targeting of Walgreens Boots by the governor of California over some of their decisions on abortion pills.
Well, you know, there's always been a handful of companies that really publicly embrace different political positions, knowing that it might turn off a certain segment of the population. Ben & Jerry's ice cream, for instance, has done that with some issues. But I think most companies would really like to avoid this fight. They don't want to be seen as playing politics. They don't want to be seen as only in a polarized nation, only chasing after about half of the market that's out there. So I think this is, we've seen people politicizing a lot of aspects of American life, and I think now we see with this decision that it's going to extend further into the business community in a way that I think will make a lot of business leaders very uncomfortable.
Really, really interesting context. Thank you very much indeed, Bloomberg's Bill Ferries on the potential showdown, or at least the increasing showdown around the debt ceiling, and then the politicization of the business climate increasingly in the US. Thank you. Coming up, traders await Fed Chair Jerome Powell's testimony, of course, before Congress, just hours away. What can markets expect? We'll bring you some previews next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to the Open. 53 minutes into the European trading day. Sentiment, as you can see on the screens, turning a little bit more positive here in Europe. Gains across the benchmark of close to 0.2%. Yields are coming in. The dollar is softer, and futures in the US pointing to upside of 0.3% on NASDAQ futures.
Now we're getting some breaking news. We found out 10 minutes ago, actually, that the Prime Minister of Qatar had resigned. We now have a new Prime Minister, and the Qatar Emir has appointed Mohammed bin Abdulrahman Al Thani as Prime Minister. Now, they have, of course, he has been a public figure in the past. I think he was Foreign Minister and also the chairman of the QIA. So we now have Sheikh Mohammed as a new Prime Minister of Qatar, Tom.
Yeah, so far, no reason being given for the change. Of course, when that reason does come through, we will bring it to you. Now, to all things central banks, and Fed Chair Jerome Powell, of course, set to give his semi-annual testimony to the Senate Banking Committee later today, and tomorrow to the House Financial Services Committee. Economists and markets will be watching for commentary on how high rates can go in the US. Markets pricing in at around 5.5% on the terminal rate. Let's bring in Bloomberg's senior Asia economy reporter then, Michelle Jamrisco. Michelle, what are we expecting from this testimony?
Well, Tom, I think we can expect Powell to be quite hawkish. I think the only question is how hawkish. We'll probably hear him say again and again, the inflation fight is not over. I think one tricky thing that he'll have to do in this testimony is talk about the data that he's seen recently and really square that sort of somber growth outlook with the fact that he's seen still tight labor markets, still high inflation, consumer spending that was strong in January. So a lot of the market pricing is making the Fed look pretty outdated in their dot plot from December, as well as some of their commentary perhaps needs to catch up with the hawkishness they're seeing with the data that they've been seeing lately. So what we're seeing is the upper bound, of course, of the Fed funds rate at 4.75 right now. Markets pricing in about 5.5% of a peak terminal rate. That will be the big question, is how high will they go and where will they end up before they start kind of easing off this tightening cycle. Of course, we're not expecting specifics from Powell on that front, but maybe he'll give conditional forward guidance. What would he need to see in jobs and inflation data that would change the Fed's thinking on this? And this will be important in a week when we have the jobs report on Friday.
Michelle, thank you so much. Bloomberg senior Asia economy reporter there, Michelle Jamrisco. We'll have plenty more on that throughout the day. Coming up in the next hour, we also speak to the Bank of England Monetary Policy Committee member, Catherine Mann. Don't miss that interview. It's at 9:30 a.m. UK time. Now, that's it for the European Market Open. Surveillance Early Edition is up next. We have a full roundup, of course, of the main stock moves. We've had a bit of breaking news on the Qatari Emirate with the Emir accepting the resignation of his prime minister. But, well, he didn't lose any time in actually appointing a new one.
And as of this moment, no reason given yet for that change. Of course, we will keep you updated on that story. Across the European equity markets, you're seeing modest gains now of around 0.2% as we look ahead to that testimony from Jay Powell. Futures in the US pointing to gains of around 0.2 as well on the S&P E-minis and the NASDAQ futures. Yields coming in across the Treasury curve between 1 and 2 basis points. And the dollar is just marginally lower. Euro dollar at 1.06. We also had some red eggs crossing from China in terms of changes to the regulatory body overseeing banking and insurance, and also an announcement that they're going to be cutting headcount around 5% from central government departments. Significant. That will mount to thousands of individuals, of course, with the context that there's about 20% unemployment amongst under 25s. Plenty more coming up across these markets, of course, including that important conversation with Catherine Mann. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Markets tread water as investors await testimony from the Fed chair on Capitol Hill, while JP Morgan's Jamie Dimon says inflation is not beaten yet. Meta is said to be planning thousands more job cuts on top of the 13% reduction in November as the social media giant races to become more efficient. Plus, we discuss inflation and BOE policy in our exclusive interview with MPC member Catherine Mann. That's at 9:30 London time. Now, first thing is first, so let's check in on the markets. Now, I guess there are a lot of these markets are actually treading water, have two key factors. First of all, what's going on with Jay Powell. There's 2 days of testimony that starts. I've had a lot of viewers writing in saying, get your popcorn ready, because it will be interesting to see how he navigates some of the questioning. And of course, Friday's monthly payrolls data could change everything. The other story we're continuing to watch very closely is what's happening in China with some of the key takeaways, of course, from the National People's Congress. European stocks for the moment getting 0.2%. Again, it's quite fluid, as we're also trying to figure out how Wall Street is looking at U.S. default. And then if you look at the difference between a CAC 40 and a FTSE, for example, there's not that much on the screen. Now, JP Morgan Chief Executive Jamie Dimon says he sees the economy actually remaining inflationary. Well, he spoke to us exclusively.
We can still have a soft landing. Mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Jamie Dimon speaking exclusively to Bloomberg's Ed Hammond on the sidelines of the JP Morgan Global High Yield and Leveraged Finance Conference in Miami. Now, across the Atlantic, ECB officials are divided over just how much to tighten. For more detail, our markets reporter Valerie Teitel joins us. Valerie, good morning. So the Hawks and the Doves squabble continues. What's the latest?
Yeah, it really was those comments from Holzman yesterday that the market is clinging onto. It was very, very hawkish, Francine. He called for 4 more 50 basis point hikes, which would implying a terminal rate of 4.5%. That is a lot higher than current market expectations, which are hovering around 4. He also sees the neutral rate at 4%, and the ECB's current depot rate is 2.5. That is implying that the ECB has a lot more to go. He also commented on QT, saying the pace should increase in the fall and include the pandemic emergency response program in those asset sales. We also heard from the Dove yesterday. That's Lane. He took a bit more dovish stance, saying we really need to look at the cumulative Titan effects. He's taking a quote out of the Fed's Brainerd's book right there. But he also warns against putting the policy on autopilot. He clearly doesn't want to promise too many of these jumbo 50 basis point hikes in a row without seeing the data come through. We also hear from another key Dove on Wednesday. That's Panetta. Watch his comments, and if it mirrors any of this pushback from the hawks, this is all ahead of next Thursday's ECB meeting.
So how did the market handle the comments?
Oh, they clearly paid attention to those hawkish comments. We saw two-year yields rising 10 basis points yesterday, and this stood out completely because treasuries are moving in the opposite direction. We've also seen a lot of sell-side analysts upgrade their calls for the ECB. That comes after the hot core inflation print yesterday, but also the whole last week, but also the Holzman comments yesterday. Nomura, Francine, is now calling for 4.25 terminal rate from the ECB, follows several others upgrading their terminal rate ECB calls to 4%.
Valerie, thanks so much. Valerie Teitel there with the very latest on the ECB. Now, later today, the focus, of course, moves to the U.S. Congress, where the Fed Chair, Jay Powell, set to testify before a Senate committee. It's a chance for Powell to signal how high he thinks rates need to go to tame inflation, following hawkish comments from other Fed in recent weeks. Well, we're now joined by our Bloomberg equities reporter, Sagarika Jaisagana. Thank you so much for joining us, Sagarika. I mean, there's a lot going on, of course. The equities are looking for the Fed to signal what they will do on interest rates, but really we have to understand inflation. What are equities telling us?
It's absolutely a big week, I think, for equity markets this week. First with Jerome Powell's comments today and tomorrow, and then the jobs report later on Friday. You know, as you know, equity markets have really been extremely sensitive to any signals around what the Fed is likely to do with rate hikes later this year. We had the big rally late last week when we saw when we had some comments that the Fed could consider a pause by the summer. I think sentiment has turned a bit cautious since then. So it all comes down to anything that Powell signals over the next 2 days about how high, as you said, he thinks rates would go. That could cause a lot of volatility.
So do the markets and actually do equities, do stocks worry more about a hike in interest rates than they do about a possible recession? Now, we have a great Bloomberg piece also looking at why the jobs data in the U.S. could underestimate some of the labor data softening.
Absolutely. I think it's really interesting. Coming into the year, there was a big consensus among market strategists saying that, this year was going to be about recession and recession expectations and how that would drive equity markets. But we've seen over and over again that it comes down to inflation. It comes down to what the Fed signals that investors react to more. And certainly over the short-term outlook, I think there's a lot of divergence now in what strategists are expecting. We heard from Morgan Stanley's Michael Wilson, who is, of course, one of the staunchest, bearish voices on Wall Street. He said that the technical indicators now, the way that it's set up, could actually support the rally over the short term. Yeah. Over the longer term, he remains a bear. And it's quite interesting because we have Wells Fargo's Chris Harvey on the other side, who said loud and clear yesterday, don't trade this like a bear market anymore because that's over. So I think March, at the end of March, once we have the jobs data, the latest inflation numbers, and then the big Fed meeting, of course, after that, investors are expecting to get some more clarity on how do you trade the rest of the year.
Yeah, the problem is that once the Fed starts talking about a possible recession, then it could be too late, right? Are there indicators in terms of stocks that specifically that we should be watching that almost advance what the Fed could say?
I think technology stocks, particularly in the U.S., are always a good example. We've had an outperformance in the NASDAQ recently. That's another indication, of the fact that they're focusing more on inflation. But cyclical sectors will also be key to watch because they have outperformed so far this year. And as soon as the recession fears sort of start coming back, they can be expected to, if they show underperformance, then that's a clear signal.
I think Warren Buffett also weighed in on share buybacks and what people thought about them. Is there a worry out there that actually companies feel so much pressure to give back to shareholders, either through share buybacks or dividends, that they're not really laying the foundation for future growth?
This is a story that we've been actually exploring since February, because again, through the earnings season, that was a standout, just how many buybacks we saw. It was a record start for the year for the US, strong start in Europe as well. So I think the indication that stock investors are sort of taking from that is that companies are still comfortable enough in the outlook that they see, the demand that they see, that they are able to announce huge programs.
All right, thank you so much for the great insight, Sagarika Shai-Singhani there, of course, from Bloomberg Equities. Now, coming up, we'll talk a lot more about the economy. Also, a new book claims the relationship between consultancies and the way business and government are managed needs to change. So we focus on the consulting industry. We also focus on exactly how governments should be run. That's coming up shortly. Plus, later in the program, Bank of England MPC member Catherine Mann joins us. Don't miss that conversation on inflation and, of course, on her hawkish voting. 9:30 London time. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Moment news breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, there is an entrenched relationship, we all know it, about the consulting industry and the way business and government are managed today. That's a claim of a new book called The Big Con. It describes what it claims to be the confidence tricks that the consulting industry performs in contracts with hollowed out and risk-averse governments and shareholder value maximizing firms. Now, we're joined by one of the book's authors, Mariana Mazzucato, who is also professor of economics at University College London, actually one of my favorite people to interview. So thank you so much, Mariana, for joining us. Congratulations on the books. Everyone's outraged. People say, look, the firms say this is not true, but this goes to the deeper problem about governments today. How are governments doing? Have they lost their North Star?
Yeah. So, well, first of all, the title is that we're all conned. It's not really about us versus them, the bad consultants versus the rest of the economy that somehow is trying to do good. We're saying that actually to tackle the most difficult challenges of our time, whether they're the ones around climate change, water, which is a huge crisis right now globally, health, so that we're actually more prepared for the next pandemic, and of course the digital divide. Just think what happened to all these students locked down in their homes globally who stopped having access to their human right to education. This requires huge amounts of investment, innovation, collaboration, collective intelligence, a word I increasingly love, between the public sector, the private sector, and civil society, including, by the way, labor unions. We should talk more about labor unions on your show.
Which we will.
And our book the subtitle is how the consulting industry has infantilized our governments, weakened our businesses, and warped our economies. And the infantilization point is, it's a bit of a chicken and egg. As governments for the last 50 years have not only often cut their budgets in terms of the whole wave of austerity here and there, but they've especially cut their investment inside their own brain. They've outsourced that brain. They've outsourced that capacity and capability.
This is priorities, right? So this is the government. It says, look, I don't know how to tackle that, so I go to a consultant. But is there a more fundamental problem? It is. But is there a more fundamental problem that actually governments don't know what they're trying to do or think about two short-term political cycles?
Yeah. Well, first of all, we're talking about a sector. So the book is about the consulting sector, the industry, that is run on a business model that has a fundamental conflict of interest. When they're advising or consulting governments, there's no actual incentive to make that government more capable. Otherwise, you don't get the next contract. As though a therapist had a client in therapy their entire life, they're probably not a very good therapist. So there's a conflict of interest there. There's also a conflict of interest in terms of how the advising, the consulting is being done, often on both sides of the street, like advising both for ESCOM
on the
and
other
the Treasury.
side, if you're a government, why do you keep on doing this? So is there something fundamentally dysfunctional about most governments in why they're in this pattern on the government side?
Exactly. So I was sort of getting to that before, which is that it's a chicken and egg problem. If you stop investing within your brain, you actually then you become also addicted to others helping you. But remember how we learned how to ride a bike. We fell off that bike. If you're not doing, you're not learning by doing. So as the doing at the center of government is increasingly outsourced, government itself stops learning. Lord Agnew in the UK talked about this in terms of the infantilization of Whitehall after he saw the figures that were coming out of the UK in terms of how much the government spent on both COVID and Brexit. We were spending in the UK $1 million a day on Deloitte to do test and trace. Now, does Deloitte have expertise on test and trace? No, so it's not actually that surprising that they failed. Look at what then happened with the vaccine rollout. Government was capable. It used the National Health Service. It used the decentralized network of GP practices to roll out the vaccine.
Government is also too small. Right. How would you change government so that they can tackle this? Because again, it's a chicken and an egg. It's like a vicious circle that keeps on repeating itself.
Yeah. So you have kindly invited me on for all my books. So The Entrepreneurial State, Value of Everything, Mission Economy, and all those 3 books that came before this one talked about exactly that. That if we have both this kind of wave of just obsessing about public deficits, which often actually increases debt to GDP, because if you're not investing in the denominator, the irony is even if the deficit is falling, debt to GDP rises. But also, if we don't actually invest within the civil service, have a creative bureaucracy, this is not about small versus large. You just asked about small. It's about smart. We need smart government. We need smart business and not an overly financialized one. You know, having spent over $1 trillion in share buybacks in the last year, over $6 trillion in the last decade, that means that we have a problem in the governance of the private sector, overly financialized, a problem in the governance of the public sector, thinking that at best it can fix market failures, and a very problematic relationship between the two.
So how do you fix that? Are we attracting the right people to government? And again, is everything too short term? I feel like we're in a very polarized world on every issue.
Well, one of the reasons I set up an institute at University College London called the Institute for Innovation and Public Purpose is precisely to tackle that. We need new education. We need a new mindset. We need new training within the civil service that is not just about new public management and public choice theory, which has, in the last 3 decades, brought efficiency metrics from the private sector into the public sector. So, and by the way, this actually started with Labor's third way, which is a bit counterintuitive. We like to blame neoliberals and conservatives for all the problems in government. This was actually a period where government was seen as useful, but we didn't actually think about for what. You know, what is the public purpose? Hence, what's the mission? And that requires metrics within government that is specific to government. So think what the BBC does with the notion of public value. I don't know any other public organization globally that is as rigorous about its internal metrics to hold it accountable as the BBC, which doesn't mean it's perfect. But this is really what I think that's needed to tackle all these problems which underlie the Sustainable Development Goals, 17 of them that the UN has set up. Every country has signed up to them. It will be impossible to tackle them without capable government, unfinancialized business, and a symbiotic relationship between the two. And the book actually looks also at the consultification of business, not just government. A lot of problematic and kind of difficult decisions that businesses are making, they prefer it to be rubber stamped by a consulting company so it kind of goes down the throat of the board as opposed to just taking ownership.
Mariana, we have so much more to talk about. Thank you so much, Mariana Mazzucato, co-author of The Bid Con, of course, stays with us. Now, we also did contact the Bid Consultancy. They declined to be interviewed. We will, however, be speaking a little bit later this week to Tamsin Isaacson, the Chief Executive Officer of the Management Consultancy Association, for any industry rebuttal to claims in Mariana's book. We are also inviting government. That interview this Friday, 9:30 a.m. London time. Now, coming up shortly, the Bank of England MPC member Catherine Mann joins us. Don't miss that exclusive conversation, 9:30 London time. And this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacroix here in London. Now, still with us, Mariana Mazzucato, professor of economics at University College London, with also this great new book talking about the big con. And this goes really to the purpose of government, Mariana. Here in the UK, we've had a turbulent, and that's probably a euphemism of the year, a turbulent 8 months in terms of, prime ministers changing hands and stuff. There's a big budget coming up. What do you want to see from the UK government?
Well, first of all, we need to get away from this dichotomy of it's either austerity or money because interest rates are low. The real question is, what do we actually need to do in the UK in terms of actually strengthening the social fabric, reducing inequality, having the greenest manufacturing sector in the world, having a digital services industry that actually supports that, and that requires investment. It requires investment from the public sector and the private sector. We were just talking about that and how they actually work together. And so the first thing is, let's not do the austerity mistake again. That's not going to help us. Brexit definitely hurt in terms of closing down the global market, which businesses need, which drive their expectations about investment. In fact, we continue to lag on investment figures, let alone the R&D figures. So we need a strong innovation system. So we need a government that actually supports an industrial strategy and innovation strategy that's not just about R&D. It's about actually strengthening all those kinds of institutions that bring science and industry together. It means strengthening public education, right? We have this dichotomous private and public education in this country. It's public education that actually allows everyone to prosper.
Mariana, if you go back to, I mean, you're saying austerity is not the right way.
It never worked, it never will work.
But does the UK need, does it feel like it needs to talk about austerity to get the markets back on track, basically, because of the wobble that we saw in the fall?
No, it's exactly the opposite. The reason that we got the wobble in the fall was because of this completely insane taxation announcement, right? So once they fixed that, the point was not then to kind of go even overboard and say, and we're not going to spend anything, we want to invest. Look at the countries globally that are leading. Look at what happened in Germany with green steel. That didn't just come out of the blue. It actually came from a public investment program. It came from loans that were provided from a state bank, conditional on the steel sector, lowering its material content, which they did in both Germany and Sweden. In this country, I think one of the biggest problems is this very problematic public-private relationship, which is not actually conditional on investment together going towards the difficult challenges of our time. Just look with COVID, for example, we gave $600 million to EasyJet with no conditions attached. Very different from France, where the COVID-19 recovery to Renault and Air France was actually conditional on those companies committing to lowering their carbon emissions.
Is it because the UK government is less interventionist?
Well, by the way, once we got Brexit, we became quite desperate to attract capital. That is not a good, feeling of security in terms of your relationship with business. What you want to do is attract businesses to come to the UK because it's seen to be a leading hub of innovation and investment in different sectors. You don't attract them by just saying, oh, you will pay less tax here, or here's a deal, some sort of backroom deal. Those deals should be explicit, like, by the way, we've seen in the United States right now. We have, for example, a CHIPS Act, which is all about actually creating sovereignty in the United States with semiconductor chips, because currently they have a real problem that they're overly dependent on Asia. But that CHIPS Act, which has been designed by the Secretary of Commerce, Gina Raimondo, has different types of conditionalities, making sure that those companies have green supply chains, that they pay workers their proper wage, that they don't just use the profits generated from a public investment program for share buybacks. This is about a good symbiotic deal, not a parasitic
and a good
one.
governance. So I keep on being told that China will not mess it up because they also have the smartest brains working for the party, working for the states. Is there anything that the UK can actually learn from China? We're also following the National People's Congress very closely.
Interesting. Well, first of all, globally, the way to attract talent into government is actually to make it really ambitious and interesting to work in government. Think what happened after the financial crisis. While in Europe and the UK especially, we were doing austerity, the US had an $800 billion stimulus program, which was supposed to be green directed. And by doing that, they actually attracted a Nobel Prize winning physicist, energy physicist, to be the head of the Department of Energy, Steve Chu. Now, you don't attract a Nobel Prize winning physicist to be a civil servant by saying, come in and help us de-risk Elon Musk, come in and help us do our carbon taxes. It was about helping to steer the economy to be more sustainable, more inclusive, something that China, by the way, is spending over $3 trillion on. And some countries are able to actually benefit from China's attempt to massively lower its pollution. Denmark is the #1 provider of high-tech green digital services to the Chinese economy. That's a really interesting relationship, as opposed to fearing China, working with China on its green transition.
Thank you so much, Mariana Mazzucato. There was a good new book, The Big Con. This is Bloomberg.
Why did you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Markets tread water as investors await testimony from the Fed chair on Capitol Hill. JP Morgan's Jamie Dimon says inflation is not beaten yet. Meta is said to be planning thousands more job cuts on top of the 13% reduction in November as the social media giant races to become more efficient. Plus, we discuss inflation and BOE policy in our exclusive interview with MPC member Catherine Mann. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's go straight into that conversation. While traders are beginning to factor in a higher terminal rate from the Bank of England, that comes against a backdrop of UK inflation still above 10%. That looks like it has little chance of reaching the bank's target anytime soon. Well, let's bring in Catherine Mann, Bank of England Monetary Policy Committee member, joining us for an exclusive conversation. Thank you so much, Catherine Mann, for joining us.
I'm delighted to be here with you, Francine.
We've been wanting to speak to you for a while. Do you now feel vindicated? You were a lonely dissenter trying to push for more interest rate hikes last year. You were right.
Well, I think I was right, but I was also basing my views on the research that indicated that front-loaded policy would be a superior strategy to achieve the equilibrium. But on the other hand, we have to remember just how strong the external forces of inflation are or have been. And so, although I'm vindicated, I also recognize that the external forces were going to be there anyway.
So what's the right balance going forward? How do you see inflation? I mean, we try and predict what the Bank of England does, but actually this is about predicting inflation first.
Right. Well, so of course there are two elements. There's the external, the gas and the goods market prices that come from abroad. Those are on the downturn in terms of they're not going to be rising as fast as they did last year. On the other hand, the part that I've always been concerned about is the extent to which there is strong pricing power of firms. There is acceptance of those higher prices by a lot of consumers, of course not all, but even in the face of the cost of living crisis, there still are a lot of people out there who are willing to pay higher prices, and firms are willing to set those prices high.
So when are you expecting to the bank to go back to that 2% inflation number?
Well, we have a forecast, and we have fan charts, and I'm in the upper part of the fan, both with regard to economic activity, but also with regard to inflation, especially core inflation. Now, of course, the bank's remit is headline inflation, but core inflation is where sustainable inflation at the 2% target has to be. So when I think about core inflation, I am concerned about this persistence, the embeddedness of the external shocks into core inflation, and both wages and, as I say, pricing power being a very important ingredient.
Catherine, how much more aggressive do you want the Bank of England to be to make sure that this doesn't get entrenched even more?
Well, I've had recent speeches where I've indicated that I thought more needed to be done in order to ensure that expectations in particular are for a declining rate of inflation and the embeddedness to be mitigated.
If you look at the terminal rate being priced in by markets around 5%, will the Bank of England push back against that?
Well, the terminal rate is, I like to think of this as the terminal rate is sort of beyond the forecast horizon at this point. And so it's very important, the journey, not necessarily the destination.
Okay, talk to me about weak pound. How much does that impact inflation?
Significantly. This is, the UK imports a lot of products. It's a small open economy. It is affected by capital flows as well as the sort of imported prices coming through the pound. And that is a very important ingredient. I did a speech middle of last year talking about spillovers, both with regard to imported prices, but also with regard to concerns about the stability of capital flows.
But if you look at the underlying condition, I guess, for a weak pound, I mean, there's nothing really, is there something that you can do, that the government can do?
Well, I don't make fiscal policy, so I'm not going to talk about that. But I think the real question right now is there has been quite a hawkish tone coming from the Federal Reserve. We'll hear a little bit more about that in due time, and of course from the ECB as well. The important question for me with regard to the pound is how much of that existing hawkish tone is already priced into the pound. If it's already priced in, then what we see is what we get. But if it's not completely priced in, then there could be depreciation pressure on the pound.
How much do you think is priced in?
They've been talking hawkish for a while, but I think perhaps there's more to go.
Talk to me a little bit about the housing market. So how much does the housing market, first of all, impact the psychology of consumers? Right. And again, this impacts the whole, the spending situation.
Well, there are a lot of different factors on the housing market that we need to consider, and we look very carefully, very disaggregated analysis on the housing market, who holds a mortgage, what the maturity of the mortgages are, when they were taken out, who's going to have to roll over at a 2-year horizon or a 5-year horizon, what the impact of that is on their potential spending power. So we do a lot of that. Now, I think one of the important questions is how what's about the wealth effect. So a lot of prices have, appreciated dramatically in the last couple of years. So there is some price depreciation, but it's really not much compared to how much prices on average appreciated over the last couple of years. So we have to take into account what the starting point was, as well as kind of the dynamics of the current pricing power.
But do you think at this point they have much further to fall, house prices?
Well, so we've seen a reduction in mortgage rates from the high point last fall. We see more competition in terms of products coming from various lenders. And so that suggests to me that there's more revival in process as opposed to a continued downward momentum.
What surprised you the most since you joined the MPC, and we'll talk maybe about how the meetings go, but in general, what surprised you the most about the UK economy? How resilient it's been, or the speed of inflation?
Well, actually, the concern that I have is something that I pointed out in the speech that I gave at the Lamfalussy conference in Hungary, and that is the supply side. And we did a supply stock take that we outlined in our monetary policy report for the February edition, and it really is striking how slow growth is in the UK. It's much slower than what we observe for the US or for the Euro area. And of course, you remember the old language of the speed limit that the central bank, well, the supply side sets the speed limit for how much the economy can grow without generating inflation. And so I really worry about the supply side of the UK economy.
But this is what also tied in with Brexit?
Well, I have commented on Brexit several times over the last year, indicating that that is a factor on the supply side, and I also believe it's a factor on pricing power.
But so it's nothing actually that will go away. Is there any, again, because of Brexit and the impact this has, how do you readjust to it? Does it make monetary policy much more complicated to say?
Well, as I said, the supply side and sort of a very lackluster supply growth does make monetary policy more complex and more complicated. Now, in terms of Brexit going forward, a lot of businesses have indicated that they've kind of managed a workaround. So the real concern is the uncertainty. Uncertainty plays into business investment, and of course business investment, as one of my colleagues, Jonathan Haskell, has said, is quite a bit lower than we would have expected based on sort of demand conditions alone.
What's it like being on the MPC? The relationship between the MPC and markets, I don't know whether that surprised you.
Well, having come from being chief economist at Citibank, I kind of knew about the relationship between central bankers and markets. We have a very, very robust market intelligence group, Andrew Hauser, Andrea Rosen, and so we get very, very good insights into market behavior. Now, I have, in my last speech, talked about the monetary policy transmission mechanism, have tried to focus on the role of financial markets in transmitting my decisions or the monetary policy decisions through the financial markets to the real economy, and thinking about that transmission mechanism and how robust it is and across the different dimensions of asset classes. This I think is a critical ingredient when we think about how tight monetary policy is, how much it has tightened. These are two different factors that affect how well monetary policy is transmitted to the real economy.
So do you also see the bank's role really in trying to guide markets? And is that relationship between guiding markets maybe sometimes a little bit too close?
You know, the too close is, I think it's very much a question. We would like the markets to be a transmitter of our monetary policy. And so in that sense, we are not going to be pushed by the markets. We have guided the markets when we think that they are on the wrong page. Last November, for example, when we thought that the yield curve was peaking at 5.25, and we thought that was inconsistent with what we thought our policy path would be. And at that point, we did have a very explicit message that was in the monetary policy statement. And the markets heard that, and there was some reaction associated with that.
Catherine, thank you so much. Catherine Mann, Bank of England MPC member, stays
associated with that.
Catherine, thank you so much. Catherine Mann, Bank of England MPC member, stays with us. We'll talk about the dot plot. If there was a dot plot for the MPC, what would Catherine's be? And we'll talk a little bit more maybe about QT, whether it should be used as a stability tool instead of a monetary policy tool. Plenty more ahead. This is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Fed Chair Jay Powell testifies before Congress. First, at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, tomorrow, he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
Let's continue our conversation, our exclusive conversation with Catherine Mann, Bank of England MPC member. Catherine, thank you so much for staying with us. Many questions, first of all, on how you view QE. Should it really still be a monetary policy tool, or would you scrap that and actually use that as a stability tool?
So it is a monetary policy tool, but it is in the background. I mean, we've been very clear to the markets exactly how much we plan to sell, the process by which we're selling it, and so it does have an effect on the monetary policy, monetary conditions. But our primary tool is the bank rate, and that's the way we view it.
Some of the things, if you look at the things that actually the bank wishes they understood more, I imagine it's why some people are staying off the labor force, so they're not coming back to work either because they feel maybe richer than they are, or long COVID.
Right.
How do you incentivize people to come back to work?
It's a real challenge, but what I worry about is that there are people who retired, I would say early, and 55 is sort of early, because there's a lot of your life left, and there's a challenge to making sure that your retirement savings are going to match your longevity. And so I worry that a couple of years down the line, we're going to see people trying to come back into the labor force, and that's going to be much more difficult. Now, we have seen just a little bit of an indication that the people who have taken sort of early retirement might be coming back for part-time positions, but it's early days on that, and as I say, I worry that people are going to find that their pensions are not sufficient for their preferred lifestyle and are going to want to come back.
But will they come back in a meaningful number to actually make a difference to employment?
Well, there are a lot of them who have left, and so I think you could see them come back. A meaningful number, perhaps not. There are other channels through which we would like to get more supply side on the labor side, educated graduates, that sort of thing on the younger end of the spectrum. That's also a key way of improving labor supply.
Are you surprised at the resilience of UK companies? And there's, the money is also going to U.S. companies because of the Inflation Reduction Act and other incentives.
Yeah.
How does that feel?
Well, there's we are sandwiched between two large geographic areas, both of whom are spending a lot of money on climate transition. The Inflation Reduction Act in the United States and Repower EU and Next Gen EU on the other side. It's important to be thinking about the implications for the supply side of the policies that are put into place.
But how do you see, there are two companies that could have listed here that also are listed elsewhere. Does that impact actually the strength of the economy longer term? So this is lack of investments, but also lack of capital.
Well, I think lack of investment is the side that I think is most important to be thinking about. In that regard, there's there's foreign direct investment, capital inflows can finance real side investment. So the listing issues are relevant, I think psychologically, importantly relevant. I think the underpinnings of why they are not listing here need to be analyzed. But from the standpoint of the supply side of the economy, business investment, innovation, that can be done with foreign capital flows or with domestic capital flows.
When you look at companies and the fact that they've been quite resilient, they have been very resilient. We haven't really seen that many defaults or zombie companies, despite interest rates going up by so much in such a short amount of time. Could that, come back to bite us later? Is there like a lag?
Well, I think we have to remember that there were a number of programs that were designed to support small and medium-sized business, and they have a different kind of term structure and repayment requirements because they were government backed. Now, for the larger companies, a lot of them took advantage of the low interest rates to put on a long-dated capital structure. So in some sense, the interest rate increases that we've seen to date are not really hitting the economy. That's part of the monetary policy transmission mechanism that I've written about.
So the big question for the Fed is actually, does it crush the economy to get inflation to 2%?
Right.
Or does it change its target, or does it become more inventive in how it sees it?
Right. Well, the Fed is much more looking at using both tools, QT, the balance sheet, as well as the Fed funds rate as complementary tools, and they do work differently, just as QE worked differently when we were at the effective lower bound. So they are using those two much more actively than we are. One of the things about changing the target is it's a challenge when you change the target when you're below it. It's also probably a bigger challenge when you change the target when you're above it. I also think that when we think about the target, it's a number, But of course, around that is, sometimes inflation is higher, sometimes it's lower. So there's a distribution. And one of the things that's important to think about is what do the tails of those distributions look like? If you're heavy on the right tail, which means kind of above, and you have downward rigidities in prices in particular, and also wages, what that means is you're more likely to end up being above the target more of the time if you raise the target.
But so what's the right way to communicate to the markets on that?
Well, I think the markets know a lot about distributions, skews, and so forth, and I think communicating that way is a very good way to communicate to the markets.
And I was told that actually it's quite difficult for the Bank of England to do anything on targets, because it's almost a virility contest between the central banks. Do you see it that way?
Well, we don't choose our remit. It comes from Parliament, so that they're the ones who have that contest.
So but is there an inventive way to not crush the economy, but also not reach 2% straight away?
Well, I don't think we're, as I say, our forecast has the headline reaching 2% because so much of the external dynamics are to deceleration. So it's more on the core inflation side that we're focused, or at least I'm focused.
You're enjoying your time?
Very much so, absolutely.
Okay, what's been the most surprising thing in meetings?
Well, very smart people and lots of different ways of looking at the same data. And I think that's a strength of the committee having, because otherwise you end up looking at things only in your own way, and having people around you challenge your views, I think is a very constructive way to do monetary policy.
Catherine Mann, thank you so much for your time today. That was, of course, Catherine Mann, Bank of England Monetary Policy Committee member. Now, let's get straight to the Bloomberg First Word News. Here's Samuel Etienne. Hi, Etienne.
Good morning, Francine. China's new foreign minister has warned about growing tensions with the relationship with the U.S. At his first press briefing since taking office late last year, Qin Gang called Washington's approach towards Beijing, quote, a reckless gamble.
The U.S. claims that it seeks to outcompete China, but does not seek conflict. Yet, in reality, its so-called competition aims to contain and suppress China in all respects and get the two countries locked in a zero-sum game.
Strikes across France are disrupting transport today, with only 1 in 5 high-speed trains running and a third of Eurostar services cut. The Paris subway and commuter trains will be severely affected. The industrial action is part of an ongoing effort against President Emmanuel Macron's plan to raise the minimum retirement age. And Goldman Sachs is losing star stock trader Joe Montesano. Bloomberg understands a 46-year-old recently told the firm he's stepping down as head of equities trading for the Americas, but is yet to line up another job. Montesano has been key in Goldman's ascent to the #1 spot in equities for the past 2 years, with total pay that rivaled CEO David Solomon's. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Etienne, thanks so much. Coming up, the Meta layoff saga continues with more staff said to be facing redundancy. More on that next, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg understands that Facebook parent Meta is planning to lay off thousands more people as soon as this week. Now, it follows November's cuts, where 11,000 workers lost their jobs. Now, let's get straight to Bloomberg's Berlin-based tech reporter Aggie Cantrell with the latest. Aggie, good morning. This will be the second round of cuts in 4 months. Was this a surprise?
So this time around, it probably wasn't a surprise. When the November cuts happened, it sent shockwaves through the tech company. In its 19-year history, it had never seen layoffs like the ones that were announced in November. However, this time around, this is all part of a bigger push for efficiency, for what Mark Zuckerberg himself has called the year of efficiency for the company, which has also been communicated in performance reviews at the company that only finished last week. And so there has been a sentiment of low morale and anxiety at Menlo Park, which has meant that a lot of people were expecting further cuts to come.
So what happens next, Aggie?
So what really happens next is that we look at what people are pushing investors for. What investors are pushing Meta for, which is essentially keeping on target for those cost efficiencies. And so what we're going to be seeing is essentially how Meta then goes on to strategize these cuts along with other projects that they have in order to save costs at the company. So for instance, we've heard about their project of flattening, which essentially means buying out managers and cutting entire teams that they see as non-essential to the company. And so we're also expecting that these cuts that are expected to take place within the next week or so before Mark Zuckerberg goes on parental leave. And for investors, this is crucial for the company as it manages to persist with this cost restructuring going forward this year.
All right, Aggie, thanks so much. Great work there on the ground. Aggie Cantrell, our tech reporter based in Berlin. Now, there is quite a lot going on today. The focus firmly on two events later today, and then on Friday, the Jay Powell testimony that starts later on. And then, of course, Friday is the U.S. payrolls number. Investors pretty much sidelined before the Powell testimony. We're seeing also support by quants, of course, highlighted after the S&P seems to be leaving the danger zone. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller in New York, and Edwards here in London, and this is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Investors waiting to hear from Fed Chair Jerome Powell. Will he lay the groundwork for higher interest rates when he testifies on Capitol Hill? Meta Platforms isn't done with job cuts yet. Bloomberg's learned that the Facebook parent plans thousands more layoffs as soon as this week. And where do you find value in an uncertain environment? We will have an exclusive conversation with top credit investor Victor Kohler of Strategic Value Partners. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, we're all going to be focused on Jerome Powell, what he has to say, whether he wants to communicate any change in thinking to the market or not.
Yeah, it's all about the Fed, but it's also all about Washington. Look, we're coming into an environment where Washington really wants this no landing scenario, no recession at all. And Jerome Powell, really the burden of proof is on him, Anna. He has to say, well, look, we kind of need one to fight inflation. I think for that reason, you are starting to see futures perhaps have a little bit of a mixed picture. That brings me to our market check for this morning. Futures only higher by 0.2%. Anna, I would not call that conviction by any measure. You even saw that in yesterday's trading, some kind of hands off the wheel kind of action, autopilot almost. And it feels like that's kind of shifting over into today's session as well. The 10-year yield hovering at 392, only lower by 3 basis points. Again, it's those round numbers you really want to be watching. 4% on the 10-year yield, 40.50 on the S&P 500. Technicals are really going to come into play when you don't know what is coming next. NYMEX crude as well. I'm going to stick with the round number theory because an 80 handle on NYMEX crude as we talk about a Chinese reopening, as we talk about just an acceleration in the economy that is lasting much longer than anyone expected, that's going to fuel the commodity complex. Right now you're seeing it flat, but let's see how that changes as risk sentiment changes throughout the day as well. And we've got to talk about the dollar because, again, flat on the session. Anna, this screams uncertainty when it comes to Jerome Powell, but I want to go back to the overnight session because that's really where we saw a little bit more clarity what was going on over in Asia, because if you look all in all with the MSCI Asia Pacific Index, you are going to see a little bit of a mixed picture, unchanged overall, but that's because China, Korea, the tech-heavy names underperformed, whereas the rest of Asia, think the Nifty 50 out of India, think the Nikkei, outperformed a little bit. But once again, no conviction, higher by only 0.3% on the Japanese index. But I want to go to the currency space because that's really where you see central banks dominating there. We're still at that band for the BOJ. Dollar yen trading at about a 135 handle. Again, nothing to write home about, but still important on that level, 135. The Aussie dollar is where all the action is. A dovish hike coming out of the RBA, and that actually sending the Aussie dollar weaker, down to the tune of about 0.8%. The question here is what kind of tone does that set for the Federal Reserve when there is still all this pressure for central banks to go higher, go be more hawkish, and hike for longer, Anna?
Yeah, interesting to see that downward pressure on the Aussie, moved yields, moved stocks, and the talk there about whether they've reached peak inflation or not, of course, as we've seen in so many other geographies. Chrissy, if it's conviction you're looking for, you're not going to find that in Europe either. We seem fairly unconvinced of which direction we're heading in here. Some of these markets in positive territory, but the London market, the Spanish market, a little more lackluster. And if I tell you that utilities is the best performing sector in Europe, that kind of tells you quite a lot about whether we have a lot of conviction on going higher from here. We're waiting for Jerome Powell, essentially, waiting for that testimony a little bit later on, Chrissy. Let me show you some of the detail we've got going on here, though. I thought this was interesting. Interesting to note what's going on the yield curves right now as we head into what we're going to get from Jerome Powell. So we see these yields coming down in Europe, and this is in Germany, in France, and in other places from recent highs, of course. I talked to a guest earlier on who was talking about in the mornings how we're seeing in Europe quite a lot of appetite for bonds. In the afternoon, that tends to turn into indigestion, and we have seen so much supply from the European government and corporate debt markets over recent months since the start of this year. In fact, record-breaking supply. John Wood Group, this is a supplier to the oil and gas sector. That stock is up by 14.7%. They've received the fourth bid for the business from Apollo in the private equity space. They have turned it down for a fourth time. We'll see what happens there. Premier Foods, they make packaged foods, this business, and the stock is up by 9.6%. They are guiding higher, essentially. It seems they have some pricing power. So wherever it is that the cost of living squeeze is hitting here in the UK, it clearly hasn't dented our appetite for packaged cakes. And this is the natural gas price, up a fraction this morning. But really, I just wanted to point to these levels. 42 euros is where we trade per megawatt hour. Of course, we've seen Morgan Stanley bringing down their estimates for the second quarter of where we get to on natural gas. We also see the EU, Chrissy, talking about bringing together their collective muscle, if you like, when it comes to buying energy from April. That's when we see that kicking in, which could be something to watch.
Yeah, really interesting stuff. The Premier Food story, Anna, is what catches my eye. I was recently introduced to packaged cakes, Jaffa cakes, I think they're called. They're interesting. I don't know how I feel about them. They're going to have to grow on me.
Oh, right, well, we could get into a whole conversation about whether that is a cake or a biscuit, has tax implications, but let's not go there.
Yeah, bigger things perhaps weighing on the minds of investors and executives around the world. Economic risks, that is. JP Morgan CEO Jamie Dimon speaking exclusively to Bloomberg. Take a listen to what he had to say.
We can still have a soft landing. Mild recession is possible. A harder recession is possible. I think there's a good chance that inflation will come down, but not enough. By the fourth quarter, the Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary.
Well, investors perhaps getting a few more clues today when Chairman Powell testifies in front of Congress. Joining us now is Bloomberg's Valerie Teitel. Valerie, what are markets going to be looking out for? There's a lot to digest in 2 days of testimony.
Curdy, it's going to be a big one today. I've got 3 questions I think the market's going to be asking to Powell. The first one, what is his view on the recent string of strong data? Does he view it as a one-off, or does he say something that it could be the start of a new trend? Does he endorse the terminal rates recent shift higher? Remember, we're now pricing above those dots that we got in December, near a 5.5 terminal rate versus the 5.1 median on those dots. Does he endorse that move as something he likes to see? And lastly, his tone on the disinflation progress so far. Remember, he used that word disinflation so many times when we heard from him last. I checked out that 71-page report that he submitted to the Senate before these hearings. That word disinflation didn't appear once.
Okay, so that will be really interesting. We will get our text counters out. There are tools on the Bloomberg to do that kind of thing, of course, to find out how many times he says that, if at all. Now, over to the ECB then, Valerie. Quite hawkish ECB comments, certainly coming from Holtzman yesterday. What were the takeaways?
These Holtzman comments really raised the bar for what the hawks are going to be pushing for next week. He called for 4 50 basis point hikes that would take the terminal rate to 4.5%. And then he said the most hawkish thing of all, that the restrictive policy stance doesn't start until they get above 4%. The current ECB depot rate is 2.5. That is implying the ECB has a long way to go. The market sure reacted to these comments yesterday. 2-year yields rose 10 basis points. The curve had some nasty bear flattening. The terminal rate has risen 60 basis points since the ECB last convened. We're seeing some very interesting trades being printed in Euribor options, betting on a 4% terminal rate by September. And the street has also been revising their calls higher. Nomura was the last one and the most hawkish. They revised their ECB terminal rate call to 4.25.
A lot to digest there. 4.25. Remember when we were talking about 4, 5, 6, the BOE, ECB, and then the Fed, and here we are inching higher already. Bloomberg's Valerie Teitel, thank you as always for walking us through it. Well, as investors waiting around trying to decide their next market move, what the trade is, their computer-driven counterparts, they don't have that luxury. Fast money quants are on a buying spree, just as the bond market creates fresh headaches for traditional money managers. Joining us now to walk us through it, Bloomberg's Justina Lee. Justina, the quants are buying stocks, but why? What do they see?
Well, by quants, we mean commodity trading advisors, and they're basically these trend-following futures trading quants. And what they look for are two things. I mean, one is price momentum, and we have seen the S&P 500 gain steadily over the past few sessions. And the other one is lower equity volatility, which essentially gives them the green light to follow that first signal. And now there is a lot of debate over, the influence of quants on the market. I have to put that out there. But if you believe in that, I think what it underscores are some of these virtuous cycle that tends to kind of get a trend going in the market.
Yeah, can this set some kind of, can it add to the momentum and then raises questions about who really is in the driving seat, I suppose. But in terms of fundamental investors, they're not buying as readily as these CTAs that you referenced, Justina. So what are they worrying about?
Yeah, I think they're really in a wait-and-see mode right now. I mean, we have seen gains in equities partly because they have started and completed that repricing of a higher Fed funds rate. And so maybe the bar for an upside surprise is actually a bit lower now. But at the same time, I think after they're done worrying about inflation, which is certainly still at the top of their minds, there's also the question of fundamentals, as we have seen those earnings numbers slowing down.
Justina, thank you very much. Bloomberg's Justina Lee with the latest on that stock trading story. Now, Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. That follows a 13% reduction in headcount in November. Bloomberg's Alex Webb joins us now with details. Alex, why might Meta see the need for even more job cuts? Because this is not the first wave.
You look at the revenue per employee at Facebook and how that has evolved over the course of the past 4 years. It's actually seen its revenue per employee decline more than 90% of the S&P 500. At the end of last year, it had 87,000 employees. That was a 22% increase still on the previous year. So you could see if your management looking at that, say there's plenty of scope for more efficiency. It's bad news for employees, but it looks as though certainly they're going to be taking more out.
Alex, the year of efficiency, isn't that what Mark Zuckerberg coined 2023 for the social media platform? Back when he said that, markets were rising. The stock was soaring. It is again this morning, higher by about 1.7%. Is that going to be the message from here on out for Meta?
Yes, it's very much a change of tone. The company, over much of the past decade, hasn't really needed to worry about efficiencies. It's been growing at such a clip. That created a certain amount of bagginess when it came to the way the company was run. By putting out that message that now we are focusing on the bottom line, not just the top line, we have seen the stock rewarded. It had been trading at historic lows when it came to multiples of forward earnings. It's really recovered significantly in the past few months, and this is underscoring some of that. As you say, the stock is trading up in the pre-market. Investors clearly not disappointed in the least by the prospect of more job cuts.
Okay, Alex, thanks very much. Alex Webb joining us there to talk about Meta and its efficiency drive. Coming up on this program then, Victor Kohler joins us, founder and chief investments officer at Strategic Value Partners. We will get his take on where we are. Big macro themes to do with the part of the investment universe that he operates in. We'll talk about the companies he runs. We'll talk about other assets that they're exposed to in aviation, in real estate, a conversation not to miss. And Jamie Dimon, we will bring you part of our conversation there, weighing in on his top concerns in an exclusive interview with Bloomberg. More from that exclusive ahead.
The thing I worry the most about, if you go, is Ukraine. It's oil, gas, so the leadership of the world, and our relationship with China. I mean, that is much more serious than the economic vibrations we all have to deal with on a day-to-day basis.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Today, Fed Chair Jay Powell testifies before Congress. First, at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, tomorrow, he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. Now, Fed Chair Jerome Powell is set to testify in Congress today as markets await any commentary on how high rates can go and how long they stay at relatively elevated levels versus recent history, at least. Let's get an investor and business owner perspective. Joining us now, I'm pleased to say, Victor Kosler, founder and CIO of Strategic Value Partners, an opportunistic credit investor boasting majority control of some 15 businesses. So, Victor, good morning to you. Welcome to London. Thank you for coming in to talk to us. And so you bring us perspective as an investor, but also as somebody who sits, at the top table in these businesses and helps to operate them. So I wonder what your perspective is as we are ready to hear from Jerome Powell later on today about rates and how high they go and, crucially, how long they stay at those kinds of levels. Is this doing damage to the U.S. corporate world that you see already?
It is. Rates are, as we look forward from here, we think rates are going to be higher for longer. And every time you say that, right, the world starts to look pretty foggy. It's hard to see, is it a shallow recession, deep recession, soft landing? These higher rates are causing enough kind of concerns out there. We think the world is foggy and tough. As we kind of look forward.
And can you give us any clues around how foggy, I suppose, given that you have majority control of some 15 businesses, so you're in those rooms trying to work out where these businesses are going. I mean, does it feel recessionary to you, or does it feel very, very different from that?
It does feel recessionary.
And that's not in the data, which is interesting.
Yeah, you know, when we look at EBITDA, we look at cash flow, a lot of our businesses. And Anna, we are very much in the old economy businesses, in manufacturing, in industrials, in business services. And when we look at a lot of those businesses, we can see flattish EBITDA. We can see even declining EBITDA last year. And all that is, it's just pointing to kind of, the concerns. When we look at the order books going forward on a bunch of our businesses, some of them are having a very sharp recovery, like coming out of the airline crash. Travel's gone up. You're starting to see a real recovery take place. But that's kind of a one-off. And a lot of your industrial businesses, with raw material prices going up, labor costs going up, passing those through, there's a lot of indigestion as we kind of look at it.
Okay, and you're here in Europe, and I mean, thinking about this higher rates environment and the damage being done perhaps to some businesses as a result, maybe that throws up some opportunities in your world. What is it that you're looking at in Europe that looks interesting in terms of opportunities?
Yeah, could I actually even step back for a moment, right? So we think what's happening today. Normally, when you get one of these downdrafts, you get the central banks with a tailwind. They lower interest rates to kind of fight the economic slowdown, and they can't. They're fighting inflation. So for the first time in my career, I have been investing for about 30-odd years. Instead of the Fed or the ECB being your friend, they are creating kind of headwinds. So I think the first point I'd just take away from that is the world as we look forward is not so great because the interest rates have to go higher to fight inflation. The other thing we find is that China has been such a huge catalyst for global growth in the US, in Europe. With the US and China starting to pull apart a little bit, that catalyst is diluted.
Yeah.
Right? And by the way, Europe accounts for, I'm not just a visitor to Europe.
Yes.
It's 40% of our book, 40% of our investment team. And we think Europe is just in a more fragile position than even the United States.
Okay, more fragile here. Chrissy, jump in.
Yeah, Victor, you spoke of indigestion, you spoke of deglobalization. What does that mean then for the liquidity picture? Are you worried about that at all in the public or the private markets?
You know, right now, when you look at the way they are performing, you'd say, what liquidity issue, right? It is. The markets seem to be, especially for the most part, over the course of the last 6-7 weeks, they have done well. But we think if you look at 2007, you had the Bear Stearns happen, and then the markets went on a tear after Bear Stearns and before Lehman. Please, I'm not trying to tell you that there is a Lehman moment, nothing like that as we kind of go forward, right? But markets can overreact. They can get a little bit giddy like they did in 2007. And to us, when we look at this new world with higher rates, with slower growth, liquidity is one of these fleeting things that can come and go. And we do worry about kind of what we have in store for us as we get into the second half.
Well, speaking of that second half story, I think it's widely known that private credit markets and lag the public market specifically. But if you start to see some of the bears in the public markets be proven right, to what extent are private markets really shielded from that, if at all?
Private markets are, they're in a much tougher place than what you might think of from the headlines, right? So the world we live in, so if you look at high yield spreads as a proxy, high yield spreads today are in the low 400s, basis point spreads to treasuries. But high yield today is much higher quality than it has ever been. There is more BB, which is the highest credit rating category of high yield out there. Much more of high yield debt is secured today than unsecured. When you adjust for it, it's not 415 basis point spreads. It's more like 550 basis point spreads. So if you just look at the private markets, you're looking at high yield spreads. They are telling you 415. That isn't quite right. And one more thought. As we look at high yield today, 20% of high yield debt is trading at a price below 80 cents, 80 cents of face. In tough times, like, when we had COVID or when we had the oil and gas crash, that number is 30%, 30%. So on the face of it, you may think private markets are healthy, but when you adjust for some of the stuff I'm describing, there are more problems there even today than what meets the eye.
Well, Victor, I'm so glad you mentioned the high yield story specifically, because a good chunk of high yield is driven by oil prices as well. How concerned are you about, say, $100 oil when it comes to reflecting in those widening credit spreads?
It is. Oil is always such a huge catalyst. What it does to electricity prices, right? For instance, especially in Europe where we are today, right? Electricity prices in Europe are a multiple of what they used to be pre the Ukraine invasion. You get oil and gas prices back to $100. It is a really large headwind. As you look at commodity prices and electricity being the first place, you'll see that very direct impact here in Europe.
And something else that can be a catalyst towards some kind of distress then, Victor, I'm thinking here of the real estate market. There are pockets of Europe where we're seeing trouble in the real estate market, and there are warning signs perhaps in other geographies as well. Where in real estate are you concerned or see opportunities at the moment? There's a lot of talk about commercial mortgage-backed securities, CMBS. Are you in that space? What's your view on the sector?
The US is a little ahead of the repricing than Europe is, right? And look, we deal in both jurisdictions. We often find that to be true, Anna. So in real estate, one of the biggest asset classes is office. New York accounts for a disproportionate amount of office CMBS office debt. Vacancies in New York are 20% and climbing. When you look at kind of a whole bunch of debt which is coming due, when you have those underlying economic characteristics, like you can't rent your space out, we think you're about ready, in a slow motion way, you're about ready to start a cascade of restructurings in office space, right? Europe's a little further behind. It is, the vacancy in London is lower, but the same impact. It's coming through, right?
Okay.
And it's going to be multi-years.
Talking of cascades sounds worrying. I mean, we've seen what cascades in property markets can do in the past.
Yeah.
Are you thinking this gets that nasty?
We think parts of it, not all of it. There are some really interesting businesses in real estate, like the logistics business, the multifamily business. Higher interest rates are going to hurt, no question about that. But they don't have the underlying business dynamics of office property. And that makes office really separate. Office accounts for typically a third of all the debt out there. And cascade do worry, right? I would not, when I think about what is going to happening to the office market and what's coming, and it all comes, Anna, it doesn't come, it comes around debt maturing. Everybody hides until the debt...
Until they can't.
Until they can't, right? And those maturities are upon us. There are a couple of very noteworthy name brand deals in the US, which are just in the process of starting those restructuring discussions, and we think it's just the start.
Okay, Victor, thank you very much. I say thank you. A lot of food for thought. Thank you very much for joining us. Victor Kosler of Strategic Value Partners joining us here in London. Coming up on the programme, we will get an economist perspective on the world right now. Anna Stupnitska joins us, global macro economist at Fidelity International. We'll talk about what to expect from Powell. What will he say around the terminal rate? What will he say about the dots and whether they are stale? They are back from December, of course. The market has moved beyond them. So we'll focus on Powell and what he might say in the here and now. That conversation coming up shortly. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
From New York City, in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors waiting to hear from Fed Chair Jerome Powell. Will he lay the groundwork for higher interest rates when he testifies on Capitol Hill? Meta Platforms isn't done with job cuts just yet. Bloomberg's learned that the Facebook parent plans thousands more layoffs as soon as this week. And Jamie Dimon's biggest concerns. In an exclusive interview, JP Morgan CEO tells Bloomberg what worries him the most when it comes to the global economy. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, we're all about waiting for Powell, waiting for him to speak. Of course, plenty more to come on that subject. Futures eking out some modest gains as we wait.
I think modest is the perfect word to describe it, Anna. You're not seeing a ton of conviction on this side of the Atlantic, especially in the pre-market trading. Futures higher by only about 0.2%. Nothing really to write home about. But I think one of the major stories that you have to watch here is simply the bond market. Remember, those round numbers really matter. 393 on the 10-year yield is where we're at. We're getting closer and closer to 4%. Last week, we were sustainably above it, only for a little bit of a technical pullback, only lower about 2 basis points this morning. But what happens if Chairman Powell really digs in his heels and said, look, we do need higher rates and we need them for longer? That's going to show up in that bond market. And the ripple effects aren't just going to be in the equity market. They're going to be in the commodity market and the FX market as well, which is why NYMEX crude is really important here. An 80 handle, which is really following, I think, risk sentiment here. Remember, just 30 minutes ago, we saw it in positive territory, now weaker by about 0.2%, and really not that affected by the dollar, which once again is kind of wavering, Anna, only stronger by 0.1%. That could all change in just a few hours, though.
Let's have a look at where we are on European markets then, Chrissy, and we are up by that's S&P futures still up by 0.2%. We'll scroll this over and show you what's going on European stocks in a moment. But broadly speaking, we are waiting for Powell, of course. There we are, up by 0.2%. So very similar, in fact, to the US futures picture. John Wood Group in focus. This is a oil services business. It's up by 14.5% this morning as they've received a fourth offer for the company from private equity, from Apollo it is, in fact, and for the fourth time, they've said no, they've turned that down. Premier Foods is also trading higher. This is a business that's upgraded guidance, a packaged food business, in fact. So it seems that some still have that pricing power despite difficulties supposedly for the consumer. And natural gas prices in focus, 42 euros a megawatt hour. We've seen Morgan Stanley bringing down their estimate of just how high those would be in the second quarter. We hear talk from the European Union as well, Chrissy, about combining forces, using their market flex, their market heft, if you like, to communally buy gas, and that's something that's going to be more of a feature of gas deals from April onwards. So certainly something to watch.
Yeah, it really is. And I think it's fascinating when you kind of tie the commodity picture to the economic picture, because this is something that we've kind of written off as a move lower. That disinflation, deflation eventually is really just a function of lower commodity prices around the world. But what if there's more to it? We should ask Anna Stupinitska, global macroeconomist at Fidelity International. She just joined us now from the London set. Anna, forgive me, I think I just messed up your last name, but nevertheless, we are thrilled to have you on. I want to start there with the commodity picture, though, and really pick up on the idea that if we start to see oil hit that $100 mark, which there seem to be tailwinds supporting that thesis, how bad are the ripple effects for the global economy?
I think we are clearly seeing the headline inflation rolling over now, and that is driven by commodities, by food prices, by base effects from last year. And so that is driving expectations as well, to some extent, inflation expectations. I think if we see a pickup in headline inflation again, there will be a lot of concern. Clearly, we are focused on core inflation, and that is very, very sticky. But if we also have headline picking up, if we have higher commodity prices, I think that will set even potentially more hawkish path from here from central banks.
Well, speaking of more hawkish, Anna, a big conversation, at least this side of the Atlantic, has really been a terminal rate of 6% or even higher. Over the weekend, Alan Blinder, who was the vice chair under Alan Greenspan over in the 1990s, had said, look, the market's getting ahead of themselves. Back in the 90s, you got to, the market was expecting 8%. They ultimately got to 6%. The market is overdoing it. Is 6% a viable number, in your opinion?
We think it is. Definitely the risks are skewed to the upside from where the dot plot is today and where the markets are pricing. We also think it's not just about the level, but perhaps more so, it's about the duration, how long the Fed will stay at that terminal rate. So it's about cumulative tightening. And so for the time being, we think that the Fed will probably revise the terminal rate up by 25 basis points for the time being. But I think if we see perhaps another inflation shock, as you say, oil prices, if we see inflation rolling over on the headline and sticky on the core, we might be looking at 6% ultimately.
Anna, good morning to you. What breaks in that scenario? If we have rates at 6%, or crucially to your point, not just at 6, but staying at 6 for a period. We just talked to Victor Kosler, who was telling us about concerns he has for the real estate sector, in particular in New York. I mean, where are you looking for cracks to emerge, I suppose, as we deal with these long and variable lags from the interest rate hikes we've already seen?
Yeah, well, I think the early cyclical sectors that are always the bellwether, of course, the property sector, that's one, and then auto sector, auto loans. So consumer-based credit would be one place to look at. And obviously, the areas that are more vague in the markets, and I think the policymakers are worried about, like private equity, private credit, I think this would be the first areas. But ultimately, we think that this huge cumulative tightening will feed into the real economy and show up everywhere and ultimately in the job market.
And does that only happen once individuals and businesses have worked, well, maybe individuals more, have worked through that stock of savings that they accumulated post-pandemic? Are we still sort of cushioned in our reaction to this Fed hiking by the fact that a lot of people, in aggregate at least, still have those savings to fall back on? That was Jamie Dimon's point he was making.
That's right. It seems to us that the COVID-related excesses are still in the system. And this is perhaps why the transmission mechanism is a little bit lagged. And so far, if we look at the supply side, actually, it's interesting. If we look across the board and at various supply chain indicators, we have seen easing. Most of those indicators are back to pre-COVID levels or even easier. But the demand side is still very strong, partly due to excess savings, and we still have probably a few months for that to unwind.
Well, Anna, speaking of that unwind specifically, talk to us a little bit about the liquidity picture here. We've had market guest after market guest say, look, the liquidity issue isn't really one to worry about. But then when you look at kind of the ripple effects, how quickly could it become one if we start to see disinflation come much, much faster than expected like we did in the 80s?
I think we are already seeing that withdrawal of liquidity. And of course, somehow the quantitative tightening has been running in the background for the time being. But I think it will be more visible in the markets at some point. And I think we shouldn't forget the experience of the late 2018, where the Fed had to suspend the quantitative tightening program. And that is something, I think, one of the risks that we potentially face as liquidity might be drying up in coming months.
We've talked a lot about the Fed and the US, and that's understandable. We're going to hear from Jerome Powell today. Anna, but thinking about other news flow over the last 24 hours or so, China looms large on the agenda, talking about their 5% growth target, but also out with a host of changes to the way they're doing business at the moment, saying that they feel contained by US policy and pushing back against that. With all of that in mind, how do international investors look on that 5% growth target? The best ways to sort of access that as we live in a very changing geopolitical context?
Yeah, I think from a macro perspective, it's a good news, because we're not going to see that massive sugar rush again, like we saw on a number of occasions previously, that would feed systemic risks down the road. So I think it's actually good to target stability. It's good to target high quality of growth, and it's been consistent with the message for some time. Of course, how to access, there are different methods or different ways of accessing, of course, apart from direct ways. We know that Europe is very much exposed, and hence actually the bounce in Europe that we're seeing now is probably partly driven by that China reopening.
Yeah, we often see some of those luxury names in Paris doing pretty well, and German industrials on the back of that. Anna, thank you very much. Anna Stupnitska of Fidelity International, thanks to her for joining us on set here in London. Coming up, more from our exclusive interview with the JP Morgan CEO, Jamie Dimon. He certainly does talk about his view of the global economy, also the impact that stock of savings is still having in the US. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, starting Monday, March 13th, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. JP Morgan CEO Jamie Dimon says the US consumer is in, quote, great shape and weighed in on the prospects of a soft landing for the US economy. He spoke exclusively to Bloomberg's Ed Hammond on the sidelines of the JP Morgan Global High Yield and Leverage Finance Conference in Miami.
the consumer still has a lot more money in their checking accounts than before COVID. They're spending 10% more than last year, 40% more than pre-COVID, and it looks like they'll have excess money to spend roughly until the end of the year. And at that point, you can say, is it a little bit of a cliff? Is it a soft landing? And also, QT has now started to bite. That also is going to happen at one point, probably later this year, and that's when you're going to know what these things do. But we can still have a soft landing. And the other thing about all this economic forecasting is Russia-Ukraine. I mean, that can change it dramatically and very, very quickly.
Do you think absent Russia-Ukraine, we will have a soft landing?
I think it's still possible, but I look at possibilities.
Likely or possible?
Possible. I think a mild recession is possible, a harder recession is possible. I think there's a good chance that inflation will come down, but not enough by the fourth quarter. The Fed may actually have to do more. And I think a lot of things that have happened in the world, think of the bigger trends, are inflationary. Infrastructure spending, the IRA Act, lessening trade with certain parts of the world, bringing trade back into America. Those things are all, the green transition is going to take a lot of capital. So all those things kind of have inflationary attributes that are very different than we've been through the last 20 years.
I'm going to come back to the consumer point in a second, but last year you talked about in your letter this sort of confluence of three major factors: QT, America rebounding from a sort of post-COVID economy fairly strongly, and then obviously the war as well. You talked about them sort of leading us into an unprecedented period. How do we get out of that period?
It's diplomacy. I mean, that's why this is not, we always talk about uncertainty in the economy and the uncertainty. I call it normal uncertainty. The weather's, we know what the weather's like. That's why these things are different. QT, coming out of COVID, the war in Ukraine. I think it's been pushed out a little bit further. I would have thought we'd be dealing with this a little bit sooner, but it does look like some of that stuff is coming to fruition at the end of this year. Russia-Ukraine, we just simply don't know. I think it's wrong to even predict, because if you look at the history of wars, they've been pretty much unpredictable, and how they play out and which ones affect the global economy and how they do. If you look at a lot of wars, they didn't affect the global economy, but they were literally in very small parts of the economy. This is not in a small part of the economy. And this is a European nation. It's Russia and it's oil and major oil and gas supply and food supply around the world. So this is a whole different attribute to it.
But then why does the consumer, particularly here in the U.S., remain, as you say, fairly bullish?
For over a period of time, their home price has been going up. Jobs are plentiful. Wages are going up at the lower end, which I think is a good thing. They've got a lot of money in their checking account. Stocks generally had gone up for 10 or 15 years. The consumer is, if you look at it today, in great shape. But I'm telling you, that's going to end at one point.
JP Morgan CEO Jamie Dimon there, speaking exclusively to Bloomberg in Miami. Global finance correspondent Shonali Bassik joins us now for a little bit more insight. What might just be going through the king of finance's brain a little bit. Shonali, we'll get to the geopolitics in a second, but Jamie Dimon has been a very outspoken supporter of the consumer, the American consumer specifically, but he's also had a lot of warnings. The economic hurricane comments, for example. Where's the word of caution this time around?
And he's not ruling out the possibility of a hard landing, even though he spoke a lot about a soft landing. Remember, I think what's important about what he said about the consumer was that even though they're in great shape, that they could face a potential cliff at the end of the year in terms of how they are saving and in terms of how the inflation might hit them at the end of the year. Why is this so important? It's because when you look at how investment bankers had come into this year, there was a hope that the second half of the year would start to clear up. But the fact that inflation is still so sticky, and you have Jamie Dimon saying that the Fed might have to do more at the end of the year, that's already starting. We're in March now. It's already starting to make the second half of the year a lot cloudier for a lot of Wall Street. The consumer cliff, the question that I would have is how steep does that cliff look? How much pain might they feel? He had a lot of words of optimism about the job market and even the wage increases across America. But again, that inflation picture at the end of the year is one question, as well as that diminishing of consumer savings. And remember, if you look also, the RBC Financial Conference starts today. We're going to hear from regional banks across the country as well that might have a different story to share about their consumers that might feel a little bit more strapped than what you're seeing from a JP Morgan consumer.
Yeah, and let's definitely not forget that, of course, Jamie Dimon was also the one who I think really kicked off the conversation on Wall Street about that 6% terminal rate, something that markets are now slowly inching their way through. I'm surprised that he wasn't more passionate about that level, something that I'm sure Chairman Powell will get a lot of questions about on Congress today.
Yeah, certainly. I mean, you look at JP Morgan, finally, we've been talking about this a lot. The consumer stocks are really coming back pretty this year. So the investment banks are really showing you that they're making more from lending than they have to pay out in deposits. That net interest margin is holding in pretty strong. But again, for a bank like JP Morgan, you are seeing the regionals have a very different story there.
And Shonali, so we heard from him about the banking landscape, about the US economy, but also about some of the more global concerns he has. And clearly the impact of Ukraine is still with us from a market perspective daily. And indeed, he's watching China very closely.
He is watching China very closely, and that is certainly where the conversation is shifting. I think one thing that's interesting here, Anna, is when we think about how Jamie Dimon has talked about the cost of this war in terms of the global economy, he's talked a lot about the energy transition, a lot about it, and so has many of his peers on Wall Street. Think about Ken Griffin as well, who wrote a whole op-ed about energy security and the need for transitioning. But now another interesting thing that you hear Jamie Dimon really starting to bring up is the cost of globalization and potentially deglobalization and the rewriting of the trade rules. That is something I think that will start to become a bigger conversation this year in terms of what types of inflationary impacts it might have above and beyond what we're already seeing, to the point, the need for a higher terminal rate. I don't know that that fixes the rules of global trade.
Certainly something we're going to keep an eye on. Bloomberg's Shonali Bassick, we thank you as always. Coming up next on the show, we're live in Washington as Fed Chair Jerome Powell prepares to take center stage on Capitol Hill later today. Testimony in the Senate, followed by testimony in the House tomorrow. We're going to break it all down. Stick with us. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's coming up ahead today. Mass French strikes and protests resume against President Macron's pension reforms. Across the Atlantic, European Commission President Ursula von der Leyen is in Canada. She'll be meeting Prime Minister Justin Trudeau in Ottawa and holding a joint press conference later today. At 10 a.m. New York time, we'll have U.S. wholesale inventories data and the spotlight also on Congress as Fed Chair Jerome Powell presents his semi-annual monetary policy report to the Senate Banking Committee. And speaking of, we should get a little bit of a preview. A lot to watch for the markets, a lot to watch for economists alike. Let's get to Michael McKee, Bloomberg International Economics and Policy Correspondent in Washington, waking up bright and early for us this morning. Mike, a lot of pressure on this testimony. The expectation here is that Chairman Powell really has the burden of proof on him, that he has to establish that they are going to be going higher for longer. How likely is it that we get that message?
Oh, you're absolutely going to get that message. The question, Kriti, is how much detail will there be in the message? The problem for Jay Powell is we've got a number of key economic indicators that are going to come out after his testimony. We'll get the jobs report on Friday. We get the CPI numbers next week. So can he really specify where they're going if he doesn't know what those are going to tell us? Are we seeing some kind of a slowdown? I have a chart here that shows where economics, where the inflation rate is, and what Powell has to do is kind of close the gap between the yellow line and the blue line there. The yellow line is where the market thinks the Fed should be. The blue line is where the Fed is right now. So does the Fed go much higher? We're going to have to wait and see what Powell says, but I'm not sure we're going to get an answer as to whether we get as far up as the market thinks the Fed needs to be.
Yeah, I mean, even if he thinks that the dots are now a bit stale then, Mike, I mean, they date back to December, is that's not necessarily the kind of message he would be at liberty to give, is it?
Well, he could say that he thinks that perhaps the dots will move up. 5.1 was the consensus median in December, and most Fed officials have said they're going to get there. The question is, do they need to go above that? And would he say that they need to go above that yet? He's probably going to just say that they need to move higher because they still have 50 basis points to go to get there. So he can hedge his bets at the moment.
Well, Mike, Chairman Powell is no stranger to political pressure, and it feels like this time around a lot of politicians, a lot of congressmen might actually say, look, do we really need a recession? Do we need those widespread layoffs that I think a lot of Wall Street has been waiting for in terms of simply the health of the economy? What could Chairman Powell's message be to the people who are convinced we don't need a recession?
Well, he's convinced we don't need a recession. He has said that many times, but can he prevent one? That's the hard part about the Fed. They have only one blunt tool, and that's interest rates. And so he can't really say there won't be a recession, and he has said there will be pain. But it is going to be interesting to see how he answers people like Elizabeth Warren, the senator from Massachusetts, who's made a big deal out of this idea that we should not see recession, we should not see people thrown out of work. There may be some pain, he'll say, but he can also point to the unemployment rate now, which is at a decade's low.
Yeah, we will certainly look with interest at the political dimension of what he's going to talk about, Mike. What's the latest thinking on lags, long and variable as they are often described? And we've seen a lot of hiking from the Fed already. I keep seeing analyst notes that talk about the way that, U.S. homeowners lock in long deals and corporates have locked in long deals when it comes to low interest rates. Does that mean that the lags are long this time?
Well, there are two aspects to lags, Anna. One is that the markets adjust interest rates much more quickly than they used to. They actually anticipate what the Fed's going to do and move up rates. But how often do you buy a home or a car? And how often do companies actually commit to major projects? It takes a while for the rate impact to hit the overall economy because these things are one-offs that take place over a period of time. So nobody really knows exactly where the level is at this point.
Yeah, and maybe that'll be a topic of conversation later on as well. Mike, thank you so much. Bloomberg's Mike McKee joining us there from Washington with a preview of what to expect from Jerome Powell as he speaks later. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
This is Bloomberg.
Our core view is still one where you're going to see economic growth resilience.
Yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy.
I'm not sure that disinflation the market was really grabbing onto at the start of the year is necessarily going to come through.
Over the second half of this year, you are going to see the consumer pause.
I think that markets are trying to sort of, frankly, start ignoring 2023. I think people are ready to get past it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
You know that scene in Love Actually where they get him to say bottle in the bar?
Really?
Yeah, that's what Bramo's doing to me in the commercial break, yeah.
Well, you said
just
that
get me to say words.
We can't say our T's, so
Well, you use D's instead.
Bottle.
There you go. That's beautiful.
Thank
That's
you.
lovely. From New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures positive 0.2% on the S&P 500. Chairman Powell on Capitol Hill a little bit later this morning, TK, in front of the Senate Banking Committee.
What's he going to say or not say? He's going to be very careful about what not to say, and that, I think, will be the interesting part. With Greg Bottle coming up here, I think it's going to be interesting to see the scenarios he lays out, and those scenarios are the same ones the Fed has.
It's really difficult for him today because he's up against the calendar, and we've talked about that calendar a few times already this week. Lisa, on Friday we've got payrolls. Next week we've got CPI, and CPI falls in the quiet period, so it's not like they can undo whatever he says today, and I think that makes today just that little bit more complex.
Especially because the data has been coming in hot. There was a story about how payrolls have come in hot over expectations for 10 straight months, which is the longest streak going back in decades. We've been talking about the Elizabeth Warren side of things. How much is there a concern that they're trying to kill jobs? I'm worried about the other side. People saying, what are you doing about inflation that is too high and that continues to surprise to the upside?
The inflation's there, but what I'm going to see here within all the economic data, the anticipation of the data, we're all data dependent, is, John, the market's walking away from the bears. I see an angst to the bears, and to see what Mike Wilson has done, to me, is buried in the news flow of the last 48
Mike
hours.
even acknowledging that maybe, at least in the short term, we can have a lift in this equity market.
Yeah, I think that's been underplayed, is that the bears are starting to, it's not that they're rationalizing a bull market, but they're just saying, okay, let's revisit our caution and when that caution clicks in.
The pushback coming from Chris Harvey of Wells Fargo, who won't even call this a bear market anymore. He's saying it's not a bear market. JP Morgan, Mislav Matejka, Marko Kolanovic just saying no, 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 no. That Q1 strength does not carry over to the second half at all.
Here's the issue that people have. People were expecting softer earnings. They got softer earnings. The response in markets was not what they were expecting. You did see the earnings expectations come down, but markets didn't follow in tandem in the same way people had forecast out.
Well, leadership came from tech to start the year, and Meta is still absolutely flying. Meta, by the way, according to our latest reporting, set to cut thousands more jobs, perhaps as soon as this week. We'll pick up on their story in just a moment. I'm going to whip through the price action just briefly. Equity futures up 0.2% on the S&P 500. Yields come in just a little bit, down by a couple of basis points, 393.24. Yesterday, the Austrian central bank governor of the ECB teed up, Tom, 0.5 percentage point hikes 4 more times. That's 200 basis points of tightening from the ECB.
I mean, Austria's got their own voice within the conservatism of the central nations, the Bundesbank. And if he mentioned my ownership of the 97-year peace down 71%.
He didn't pick up on that. I'm sure he remembers that time we met on the plane on the way to Jackson Hole.
That's a great idea. I'll buy that. Great.
I said, Tom, that's the biggest talk on the ECB. And then TK strikes up a conversation. What were you talking about?
Bonds.
Century bonds.
What do you got that I can buy? And he goes, I'm sorry, it's not 100 years, it's 99 years. And there I was at 110, 115, and you're loving it down 71% right now. That's called yield up, price down.
Yeah, do you want to hold that to maturity?
Yeah.
Yeah, we can try. I don't think we'll be around for that one.
Yeah, well, I think that this is going to be the issue, especially if you end up with yields that much higher, that you're going to have to hope to be around in 2010, I believe, is when that bond matures. All right, here's what we're looking at today. Adam, you were talking about Mike Wilson coming out and kind of caving a little bit to the bullish sentiment. He is chief U.S. equity strategist at Morgan Stanley, and he's gotten it right so many times. But here's the issue that I really want to hear from him. He's actually been right about a lot of the earnings, about a lot of the economics, and yet he hasn't been right about the market response to it. So what do we take away from that? Who is driving the market action? Is it quants, or is it perhaps something else that is going to reset his expectations? 10 a.m., this is the main event. Fed Chair Jay Powell testifying before the Senate Banking Committee on Capitol Hill. Tomorrow he goes to the House. Here's my issue. I really do think that the bigger concern for him is explaining how far they have to go to fight inflation and whether they've gone far enough, whether they've actually done enough to dampen financial conditions, because that, to me, is going to be some of the bigger concerns on the main group of senators, not necessarily the concern about employment, because employment is so strong. And at 3 p.m., we get U.S. consumer credit. And here's the issue with that. I'm curious how much people are reducing their credit card bills with higher rates versus the opposite, borrowing to continue their spending as their savings get whittled down, John. We talk about the consumer. How long can they remain resilient? How long can they keep spending? Consumer credit might give some sense of where the sentiment is on that front.
Lisa, thanks for that. Let's kick off the conversation this morning with Greg Boutor, the US head of equity and derivative strategy over at BNP Paribas. Greg, wonderful to hear from you. As always, sir, good to see you. A little bit later this morning, we catch up with Chairman Powell down on Capitol Hill. What are you and the team looking for from the chairman?
Yes, I think everybody's going to be going through this with a fine-tooth comb. You made the point at the top of the show that there is really a problem in terms of the sequencing of the data here. We're going to hear from Chair Powell today, tomorrow, but the real problem is what the Fed are looking for is the data, and Powell isn't going to have the data. So Friday's payrolls number is really going to be a key print. After we saw this massive positive surprise in January, we're looking at whether there's some seasonality, some one-off factors there, or whether there is actually a kind of more sustainable hawkish narrative coming through the labor market, and that's what's going to drive the Fed.
Greg, you talk about one outcome, which is a Goldilocks outcome. Let's go there right now. With a Goldilocks outcome, what do central banks do, and what do the equity markets, how do they respond?
I think the Goldilocks scenario that we see is the least probable of the outcomes, and it's really what the market's been pricing at the start of this year, the U.S. equity market. It's this idea that we do get this gradual fading of inflation, and the Fed are able to engineer this no landing or soft landing. We still get robust growth. We don't get a collapse in margins. We don't have to see a large correction in the labor market, a large pickup of unemployment, and that contains inflation. Seems probably a challenging or very narrow runway to land on.
What I see right now, and I'd like you to fold it into derivative strategy, there seems to be a shocking partition in the market between profit and free cash flow generators and non-profitable companies. How do you see that within the derivative market of almost a bipart market?
Well, certainly one of the things we've seen at the start of this year, Tom, has been price action that I think has been quite divorced from fundamentals. So we've seen this deterioration in terms of the earnings picture, yet we've really seen some very strong outperformance of some of the kind of least profitable or lower quality parts of the tech or growth spectrum of the market. We have a basket that we track at BNP, but it's called our squeeze basket. And it basically consists of the names with the largest short interest and the names that have seen the largest open interest in call options increase over a monthly basis. And this basket really peaked at the end of January. We've seen a little bit of a reversal since the rates market has started to reprice, and we've seen slightly higher rates. So our opinion is that this was largely technical, and we think that it's going to start to fade.
So let's lean into this idea that the fundamentals are somewhat divorced from what we're seeing in the market. I was reading an article about the increased use of quantitative trading and momentum traders and how they seem to be leading the charge so far. How do you sort of game that out when coming up with a forecast of when they sort of hit a wall and are forced to reckon with fundamentals that you say are very different?
I think the thing about quantitative strategies, and we track things like vol target funds, CTAs, other kind of factorial exposures, and what you tend to find is that these things don't tend to set the direction of the market, but more tend to amplify the moves when we get them. So momentum, trend following, by their nature, are exacerbating the moves that we already see in the market. So I think it is fair to say that the stronger start we've seen to equity markets here is not entirely divorced from fundamentals. It has in fact been triggered by better growth that we saw in the back end of last year, and again some strong data that we've seen the start of this year. But it has snowballed into a more technical rally that has seen a squeeze in some of the least loved names. The question for us, and this is what we address in our outlook that we published this morning, Unfinished Business, is how that data is going to manifest in terms of central bank policy. And I think the risk that the equity market is not really priced for here is that stronger data in turn drives a more hawkish Fed that ultimately is going to be challenging for the equity market, indeed the economy, further down the line.
We've been talking with analyst after analyst who have changed their views on what's going to happen this year several times already in the first 2 months of the year. How have your views changed as we've gotten different data?
Yeah, so our equity market view is unchanged from where we are at the start of the year. We still expect to see a recession this year. Our economists have pushed that back 1 quarter from Q2 to Q3, but we actually now expect that recession to happen from a backdrop of even higher terminal rates. So the expectation from our economics team is that the Fed get to 5.75. So the issue we have for equity markets is when we look at things from a valuation perspective, we already have an equity risk premium, which is at multi-decade lows. If we are going to have a more hawkish reaction function from the Fed and ultimately a recession, as this tightening that we've seen, this very rapid pace of tightening over the last year feeds through into the real economy, then we think it creates a very difficult environment for the equity market in terms of valuations. And we think in terms of fundamentals, margin compression, we still think is coming. And that's going to be a very difficult backdrop to navigate.
Let's just quickly put some numbers on that, Greg, then. So you've got Carl Riccadonna over at 575 on Fed funds. You're on what on the S&P 500? 600 points lower?
Yeah, so we see the S&P troughing around 3,400. I think the big difference that we have in our U.S. equity forecast, and we've had this all year versus our peers, is what our peers have generally been looking for is some kind of trough, some kind of capitulation that sees the market trade down to lower 3,000s. But then ultimately, many of our peers have the market then recovering and having a kind of strong back end of the year to kind of finish close to where we are now. The big difference in our forecast is that we see the market getting down to 3,400, but then potentially flatlining through the second half of the year. Because if we do get this recession that we're forecasting, we don't expect to get a super accommodative Fed and very easy monetary policy. We don't expect fiscal stimulus to help bail the market out. So we think we could get a very different type of equity reaction function to that kind of bear market capitulation than the V-shaped recovery that we saw almost 3 years ago.
Wow, some big calls there. Greg, thank you.
It was on the edge
Greg
of Rambo.
Balto of BNP Paribas. Greg, what's that, 15% from here, downside?
I don't know. Lisa's still over there doing the math.
It's 16% downside from where we closed yesterday.
Wow, there's some real
She's got
downside.
a spark station.
575 from Carl Riccadonna. on Fed funds.
This is where we are. We can talk
big
about
number.
this coming back. Numbers and views, the narrative is shifting.
Got another view. Mike Wilson of Morgan Stanley, 8 a.m. Eastern Time, about an hour and 48 minutes from now. Don't miss that conversation. Future's just about positive. Chairman Powell coming up a little bit later this morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will propose raising taxes on wealthy Americans to help avert a Medicare funding crisis. His plan would boost Medicare taxes from 3.8% to 5% on certain kinds of income above $400,000. It also would allow the government new power to negotiate drug prices for Medicare. Bloomberg has learned that more job cuts are on the way at Meta Platforms. The parent of Facebook will cut thousands of employees as soon as this week. Now, that follows a 13% reduction in November. Meta has seen a slowdown in advertising revenue and has shifted focus to a virtual reality platform called the Metaverse. The new foreign minister of China warns that the U.S. approach to Beijing is a reckless gamble. Qin Gang says the U.S. is trying to contain and suppress China and get the two countries locked in a zero-sum game. Now, he accused the U.S. of creating a crisis over Taiwan and criticized the use of sanctions in Russia's war in Ukraine. In France, unions are hoping to bring the country to a standstill in a 6-day of protests. They're demonstrating against President Emmanuel Macron's plan to raise a minimum retirement age. Transportation is likely to be severely disrupted. Only one of every 5 high-speed trains will be running. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Moment news breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today, Fed Chair Jay Powell testifies before Congress. First, at 10 a.m., Powell appears before the Senate Committee on Banking, Housing, and Urban Affairs. Then, tomorrow, he goes before the House Financial Services Committee. How high will rates go and for how long? Are the Fed's aggressive hikes prioritizing unemployment over workers? Are Republican threats of default justified? Tune in to Bloomberg Television and Radio each day for live coverage. Bloomberg, your global business authority.
We made a lot of progress, but there's so much more to do. When you respond to a fire, you don't leave until the fire's out. Well, I'm telling my colleagues, don't leave till we finish the job. We got more to do. I'm determined to finish the job.
The President of the United States there at the Firefighters Conference in the last 24 hours. Live from New York City this morning. Good morning to you all. Big day for Wall Street. Chairman Powell speaking a little bit later this morning at 10 a.m. Eastern Time in front of the Senate Banking Committee. Look out for that. Going into it, equity futures shaping up as follows. 3-day winning streak on the S&P 500. Believe it or not, the 3-day winning streak is the longest since early February. That's how dicey things have been over the last month. Equity futures right now up 8 points, positive 0.2%. Yields come in 2 or 3 basis points on a 10-year, still just short of 4% after reaching that milestone last week for the first time since November. Your 10-year right now 392.84. Just on China, some really interesting comments through this morning from various officials, including Xi Jinping, but this from the foreign minister, who many of you will remember was the former Chinese ambassador to the United States. Here's the quote for you. The US claims that it seeks to outcompete China but does not seek conflict. Yet in reality, the so-called competition aims to contain and suppress China, Tom, in all respects, and get the two countries locked in a zero-sum game.
I don't know where it ends up. I really don't have a handle right now on it. I think it's important that the Speaker of the House, I believe, is going to meet Taiwan authorities in some form of America, whether it's Hawaii or the West Coast. Maybe he's not going to travel to Taiwan. It's very delicate now on multiple fronts.
Well, look at this language, Tom. The approach taken by Washington to Beijing is, quote, a reckless gamble with the stakes being the fundamental interest of the two peoples and even the future of humanity.
Well, they're taking
some pretty dramatic language there.
Yeah, that's dramatic language, and maybe it's lost in translation, but at the same time, this is a new China. More than anything, I would suggest it's a new China. It'll be something with us. Lisa?
Well, the official translation actually was watered down, and if you actually did the verbatim, that was the real fiery rhetoric. So I do wonder who they're talking to, and it raises a question of whether they're using the U.S. as kind of a political hot-button issue to try to garner support locally when there are a lot of issues facing that nation.
Exactly. Really well said, and I've also been told there's a lot of idiomatic phrases here where there's nuance in body language between the niceties where in English we translate it verbatim and maybe they don't.
Well, to be clear, U.S. officials, a lot of the statements on China aren't for China either, right?
But that's
for domestic consumption.
But that's a great point. How do you then bring two nations together that may have common ground but don't necessarily have a reason to express it publicly, given where the populations are?
Where we are right now on China. We're going to digress here with a brutal note this morning from Greg Valliere, widely read from AGF Investments, and it was shocking how he addressed what's going on in Ukraine. I would suggest it's beneath the headlines of happy talk in America. He harkens back to Leningrad of 1942, and far more the emotions of a 1-mile charge of the Confederacy Pickett's charge at Gettysburg. Anne-Marie Horton joins us now on Ukraine with her recent reporting, I should say, in Poland. Anne-Marie Horton, I was thunderstruck by Greg Valliere's use of history right now. It's not something trite like, is Bakhmut the new Gettysburg, but just what exactly is going on and the violence, the viciousness of this war?
Well, this is really the epicenter of the fighting and the most brutal fighting, as you mentioned, Tom, in eastern Ukraine. This is in the Donetsk region, and you really see all forces at play here. Zelensky was out last night saying no one will be abandoned in Ukraine, even though you do have a really proper offensive coming from the Russians. But you also have Defense Minister Shoigu talking about the fact that why Bakhmut is so important for the Russians. He's saying that this is a link of the Ukrainian defense forces. So if they're able to capture Bakhmut, it is really the only way they have to really maintain that control in eastern Ukraine. But the Russians are fighting also amongst themselves in the eastern part, specifically in Bakhmut. And you see this from Yevgeny Prigozhin of the Wagner Group saying to the Russian military, you're not giving us enough to succeed here. So potentially you could see the Ukrainians try to divide the Russians in this city. And this is one thing that a former Putin advisor was taking to Telegram and explaining to the world of some of the intricacies that's happening.
With your reporting and Maria Tadeo's, are the allies on the same page of the immediacy of supporting Zelensky and the Ukrainians?
I think they are at this point, and let's potentially see what happens on Friday, right? You have Ursula von der Leyen coming to the White House. This is on the heels of Olaf Scholz coming to the White House, and the United States is making it very clear that they want to continue to support and defend Ukraine to the very end. What you hear from Ukrainians time and time again, besides the ask for more weapons, right now, obviously, it's F-16s that are at the top of their agenda, is that they need sustainable renewals of ammunition. And this is really what it's come down to.
Hey, mate, we need to talk about what's happening at home. Last week, we talked about the C-suite in America, financial institutions being caught between blue states and red states. And what we're seeing more recently is not just the C-suite in America, the financial institutions, but also Walgreens. So last week it was about banks and whether they could do business with states like New York or whether they could do business with states like Texas based on their views on fossil fuels. This week it's about Walgreens and birth control. Mh, can you tell us what's happening with Walgreens, with California, and Gavin Newsom, the governor there, and how this is going to look going forward?
Well, it's a great point, Jonathan, this back and forth between the blue states and the red states and how it's becoming incredibly difficult for corporate America to navigate. So last week, what you had Walgreens say is that they're not going to be selling this abortion pill in some 20 states because those attorney generals said that they will get sued because this is illegal in those states, following obviously what happened with Roe v. Wade. Now you have Governor Gavin Newsom of California saying that California, the state, will not do business with Walgreens because what Walgreens is doing in these red states. So corporate America is finding it very difficult at this moment to figure out, one, the laws and legality in some of these states, but also what the pushback will be from the other side. And this is just the latest in a string of, I'm sure, many to come, because these issues are really being politicized at the moment.
Are we asking corporate America, Anne-Marie, to choose between doing business with states like New York, states like California, or states like Texas?
I think from a state level, that is what you are seeing, whether or not it's a comptroller, attorney general, or governor, you are seeing these states basically telling companies that they have to choose. But from a federal level, that's not happening yet. But that's what it does feel like. They are feel like they are being pushed and pulled in either direction. And at some point, the problem is this is going to hurt everyday Americans, right? This is going to hurt, I mean, with this particular instance, when it comes to this abortion pill, this is and also just stopping business with Walgreens in general, this is going to come down to hurting everyday Americans. But I imagine there's going to be a lot of legal battles, Jonathan, when it comes to this decision in particular.
MH, thank you on the latest, Anne-Marie there. It's difficult to assess just how much business the state of California does with a company like Walgreens, Lisa, but clearly you can gauge the direction of travel here on several fronts.
You said last week, risk mitigation. That is going to be the issue for the C-suite. They want to basically reduce the risk. And if you have 21 attorneys general coming out and saying, if you do this, we're not going to allow you in our state, well, then the risk is to not sell in those states. What California is trying to do is to say on the other side, you know what, we're going to ban you if you don't sell this, which basically creates a quagmire of the ultimate size for a lot of the executives of these companies. Who do they cater to?
James Dimon, I think he loves Florida. Is he going to get wrapped up in this? Is big banking going to get wrapped up in this?
Unclear. I want to be very clear. It won't stop Walgreens from operating in California. It's about whether the state of California will do business with Walgreens. And that's the lever that states like Texas have to pull as well.
At a certain point, though, how does corporate America deal with a very polarized America?
Tremendously difficult. Tremendously difficult. I mean, we sort of look down our nose about the red tape in Europe. Look what's developing here in the United States. Super, super hard to operate here with this as your backdrop. From New York, this is Bloomberg.
investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures with just a little bit of a lift on the S&P 500, up a little more than 0.1% on the S&P. On the Nasdaq, up 0.25%. Greg Bowdle of BNP Paribas on the program 30 minutes ago. So the team over at BNP, Carl Riccadonna, the chief economist there, is looking for 5.75 on Fed funds. That's the terminal rate, the peak they're looking for. And Greg thinks there's about 800 points of downside into year end on the S&P. Lisa did the maths, that's about 16% from the close yesterday. Lisa, that's some downside in the equity market. That's the call from BNP at least.
What drives it? What's the trigger for the reversal? Because we've already priced in higher rates. We've already priced in earnings expectations that are coming down. We've seen some margin compression, perhaps not as much as some people had expected. What's the trigger now?
5.75 and growth decelerates. That's the view, that this Fed has to take rates to the point where growth starts to get hurt. And I'm with you. To this point so far, we haven't seen that in a major way. They just don't believe clearly that the numbers we saw in January are going to carry on through the rest of this year.
I would suggest that there's a bet that we will have disinflation. It's still in the market now. Is it Ed Hyman disinflation? I don't know. David Rosenberg?
Well, it's not just disinflation, Tom. It's how you achieve that disinflation. Do you need growth to get absolutely hammered to achieve that disinflation?
In the scenario of the NASDAQ up 17%, make it 18% off the October low, is the growth slowdown is not all that much, and maybe the disinflation is not all that much.
It's also a sequencing. It's a sequencing issue as well, because if you get declining growth, right, like you're saying, for the rest of the year, and then all of a sudden people say, well, wait a second, maybe inflation isn't so bad. Maybe we can actually expect it to go down more significantly. Then rates come in, and then all of a sudden you have the beginning of a new bull cycle. I mean, this is what you get the bulls arguing, that it basically takes the pressure off the Fed and accelerates some sort of pause.
I'd suggest if you've got that backdrop, there'd be a lot of people screaming earnings will be absolutely dreadful against the backdrop of growth decelerating, inflation rolling over, and rates still in and around 550. Can you get bullish earnings on that? That's hard.
It's hard, especially when you've already had some negative surprises, and yet there still is this optimism.
I want to get to the bond market as well. Let's look at 2s, 10s, and 30s. Your 2-year looks a little something like this. 485.48 after going through 490 last week. Your 10-year 392.84 after having a look at 4% last week. At one point last week, 2s out to 30s, the whole curve was 4% plus. And now we've got a 30-year back to about 386. Just to run you through the next couple of days, Chairman Powell is later in front of the Senate Banking Committee at 10 a.m. Eastern Time. Then after that, you're going to see Powell in front of the House Financial Services Committee tomorrow. Then it's on to payrolls on Friday and CPI next week as well. CPI on the 14th falls in a quiet period for the Fed, so it's not like they can all come out and talk about what they think they should do off the back of CPI, Tom. So the Fed speak ends at the end of this week.
We're going to get a brief now. Alan Russ going to join us here in a moment. First, Michael McKee is in Washington, our international economics and policy correspondent here, waiting for what we're going to see and the Sherrod Brown, Tim Scott, Jerome Powell derby. Mike, you and I are the only two within the Beltway that still call it Humphrey Hawkins' testimony. How will this be different than the other gazillion before when he's up against Brown of Ohio and Scott of the South?
Well, it won't be significantly different because every hearing that the Fed chair attends is an effort by members of the Republican and Democratic parties to get him on their side. There is going to be some dispute about how far the Fed has to go and whether or not they are going to be sacrificing Americans' jobs in the cause of bringing down inflation. I would add to your list, Tom, Elizabeth Warren, who's been very outspoken about this. We should hear from her on that. One thing we haven't talked about, because we've been so focused on whether or not he'll say interest rates are going up, is the debt ceiling and the idea that we might see a government shutdown come October. I'm sure those topics will come up, and he'll be asked to take sides, and he will do his best to avoid doing that.
Who is opposite of the senator from Massachusetts? Who is the Republican that is the opposite of Warren?
Well, probably any of them would take the view that the inflation rate is something that needs to come down. Nobody's going to endorse losing jobs, but they will point out that the unemployment rate is 3.4%. And so inflation takes a toll on everybody, including the lowest paid. And so the primary goal of the Fed should be to bring that down. Fed argument is we've gone from 0 to 475 basis points, 4.75% in a year, and we are not seeing the economy slow. So we have to go higher. We've only taken away accommodation at this point. It really hasn't hit the idea of some sort of effort to slow the economy. That hasn't happened yet. We haven't gotten restrictive, so we may have to go a little bit further.
Michael McKee, thank you so much. Greatly appreciated this morning, and much more coverage from Mr. McKee as we hear from the chairman. Look for that on Bloomberg Radio and Bloomberg Television this morning. He is with Deutsche Bank, and they have absolutely nailed the recession delay called. There's no other way to put it. Out front on it, Alan Ruskin joins us now, their chief international strategist. Alan, to get started, and I got 8 ways to go here, let me talk to you about one of your glide paths, which is, as I mentioned to John earlier, we don't get the outright disinflation back to the romance of 3 or dare I say 2%, but we get back to moderately inflated. Then what?
Then we have a problem, Tom, because Fed credibility, I think, is really on edge. I think they're committed to that 2% inflation target. And if it looks like it's not achievable, then, well, eventually you'd expect that they'd have to raise the target or alternatively place much more additional pressure, downside pressure on inflation. And I think it's the latter course of action that is the first course of action, that they would just tighten up that much more, really, in a way. So it really means probably a higher terminal rate and greater risk of a recession. And, ultimately, inflation does come down.
There's been a feeling that as inflation comes down and as we see recession calls start to loom more seriously and more significantly, perhaps more imminently, that you're going to see the long end of the yield curve come in and stabilize. And yet your colleague George Saravelos was talking about the Bank of Japan and how they're actually going to see 2% inflation and they're going to raise rates more significantly. How does that translate to a view of longer-term U.S. debt?
Yeah, look, I think the Japanese role in funding the U.S. Fiscal deficit and the current account deficit is much exaggerated. Japan has not been a major player for some time now in terms of portfolio flows, so I wouldn't worry on that score. I think what is going to be very interesting is that you could build into a scenario, and it feels at least as much the end of this year or 2024 story, where you start to think in terms of the Fed rate cycle turning over and the Japanese rate cycle just beginning, and that makes obviously for a much stronger yen. I think the market has maybe been a little bit premature in thinking in those terms. Obviously, yen appreciated quite sharply towards the end of last year. has performed less well recently. But I think there is that scenario out there towards the end of this year where you have this disjuncture between the BOJ and the Fed that could actually be very, very helpful from a yen exchange rate standpoint. But I would not suggest that, just because the Japanese might be buying somewhat less in the way of U.S. debt, that U.S. yields are going to be much higher because of that.
I mentioned the Bank of Japan because Friday is Kuroda's last meeting, and where people are assuming that you're going to get some peaceful transfer of the regime, the monetary regime that he has overseen. Where does the next disruption come from, Alan, especially as we look out to this idea of the reopening trade in China, possibly already having run its course, and this feeling of disinflation that now is just a question mark?
Yeah, look, I think Japan is still a potential source of market disjuncture in so much as the BOJs try to prime the market and allow the market to effectively get out of some unhealthy long bond positions. But there's all the possibility that eventually JGB yields, 10-year yields jump substantially. And you could envisage that, full normalization. You could even have, a 10-year JGB yield climbing from, say, 1.5 to into the 2s kind of thing, and a long-run equilibrium rate and in terms of short-term rates at 2% were the BOJ to get into a proper tightening cycle. So it still feels to me like there's a lot of room for disruption from the BOJ standpoint. I don't think that's the story for the next, at least for the next month or so. Right now, I think we're focused much closer to home.
Alan, how do we make central bank boring again? How do we do that with balance sheets this big?
Sorry, how do we make
central banking boring again? Central bank policy is just completely dominated and taken over for much of the last decade. How do we get back to the old days?
I think these maybe are the old days, right? The old days are a sense of change in terms of short-term rates, a sense in which rates are well above zero, and interest rate differentials do drive currencies and create volatility. I think we're, in fact, sort of to some extent normalizing. And if anything, I think we're going to come out of this cycle with an equilibrium interest rate that is definitely higher than it was pre-COVID. So in that sense, I think this is actually a return to the old normal, as it were.
Anna Ruskin at Deutsche Bank. Anna, thank you. Those balance sheets, Lisa, they look normal to you?
Well, and if they don't look normal, which they don't because it's $8 trillion in the U.S. and all around the world, if you take a look, we've actually had quantitative easing over the past year, not quantitative tightening.
Yeah.
There's a question of, well, do we go back to smaller balance sheets? Do we shrink them? Or do we just sort of let this be the new normal amid a backdrop of boring central bank policy?
I'd love for it to be boring again. Can you imagine the disruption of Japan trying to really unwind that balance sheet?
So here's the thing. Alan Ruskin was saying he doesn't think that the Japanese really fund the account deficit for the U.S., so it wouldn't have as big of an effect on Treasury yields. I don't know. I mean, honestly, this has been one of the big tail risks, people seeing the potential for 10-year Treasury yields going over 5% if Japanese buyers suddenly have 1.5 to 2% yields on 10-year JGBs.
I like how you described it, the peaceful transfer of power, Tom, from one central banker to another. Like that's where, that's where we're at now. That's where we're at.
I've been thinking about this the last couple of days, and that you're going to get back to what we remember 20 years ago, which is to daily calculate where the U.S. 10-year should be, but it's not, because foreigners have bid up the price, bringing the yield in a little bit. We haven't really had that conversation for 2 decades. It's going to be a delta of a quarter-point yield, half-point yield, 3/4. It's huge.
The 10-year right now in Japan just short of 50 basis points balance right. Ultimately, that would mean some major changes down the road. We'll talk about that later in the week. What is it, March 10th?
Yeah.
For Governor Kuroda.
Last meeting.
Last meeting. Wow, 10 years has gone by fast.
And It's been a transformative 10 years.
Futures positive 0.2. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The job cuts aren't over at Facebook parent Meta Platforms. Bloomberg's learned the company is planning a new round of layoffs and will cut thousands of employees as soon as this week. In November, Meta eliminated 11,000 jobs, 13% of its workforce. Taiwan's President Tsai Ing-wen reportedly persuaded House Speaker Kevin McCarthy to meet in the U.S. due to security concerns. According to the Financial Times, Tsai's government shared intelligence with McCarthy about threats posed by China. McCarthy has said he wanted to visit Taiwan at some point. The powerful sister of North Korean leader Kim Jong-un has issued a new warning to the U.S. and South Korea. Kim Yo-jong is threatening severe consequences if the two countries go ahead with joint military drills next month. Last month, North Korea threatened to turn the Pacific Ocean into a firing range if the exercises took place. President Biden is reportedly considering reinstating the detention of migrant families who cross the border illegally as his administration prepares for the end of Title 42. According to the New York Times, no final decision has been made. The more restrictive measures would be a reversal for the president, who wanted a more humane immigration system. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
The most about is Ukraine. It's oil, gas, the leadership of the world, and our relationship with China. I mean that is much more serious than the economic vibrations we all have to deal with on a day-to-day basis.
Always good to hear from Jamie Dimon, the JP Morgan Chase chairman and CEO on Bloomberg TV and on Bloomberg Radio. Equity futures right now on the S&P positive, a little more than 0.1% on the S&P 500. 3-day winning streak on the S&P 500. Can we make it 4? 3 days, believe it or not, the longest since early February. I keep saying that because I can't believe it. It's been a month and change since we put together 3 days of gains on the S&P 500. Yields down about 3 basis points. Your 10-year 392.45 as we all count down to Chairman Powell a little bit later this morning, 10 a.m. Eastern Time, in front of the Senate Banking Committee, Tom. Then it's on to Wednesday in front of the House Financial Services Committee, and then it's on to Friday, really. It's about the data, it's payrolls,
and that's
just
what
around
he's
the corner.
Going to tell them. He's going to tell these people, whatever their angle is, whatever, as you mentioned, John, the film moment they want to get with the chairman, he's going to say, I'm waiting for the data. You should too. I don't think politicians want to wait for the data. They're worried about what happens tonight at dinner.
I don't think people in markets want to wait for the data.
Yeah, I think there's a lot of that going on, and this is the ex post reality for every central bank.
Is he open to a bigger move at the next meeting if indeed this February data that comes in on Friday confirms what we saw in January. I'm not saying 500,000, but I'm saying 300 plus on payrolls. Does that encourage a bigger move?
No, I'm not going to give you my opinion. No one cares. I will say the following. I will say the following. Without question, on a risk basis, to be measured gives you less error than to be jumpy. That's, I mean, we went to silence there. Is that?
But we just thought you had more to say.
My opinion.
No, we just thought you had more to say. You're finished. Okay, I didn't know you were sort of like.
I'm not finished. I'm just saying Greenspan invented measure because he was risk averse. Yeah. And Powell's no different. I mean, it's all there's to it. Let's jump to this and say the segment because this could be my last interview with Bloomberg. Lupin Rahman joins us. We are thrilled to have her back, really to begin our coverage of what the International Monetary Fund will be doing here 1 month out. We're making a lot of good plans on that. John Farrow leading our planning meetings on IMF spring meetings. Lupin Rahman is with PIMCO and is well versed on the emerging markets. Lupin, let's start with the beginning. To me, there's two EMs at the minimum, the frontier economies, greatly beleaguered, and another EM of great prosperity. Or dare I say, could there be three worlds of EM? Which is it?
I think EM is extremely diversified right now, and you hit the nail on the head in terms of bifurcating the frontier economies, especially the low single B high yield economies that are facing a lot of stress. Some of them have very large external financing needs. They're having to have IMF programs or other bilateral lines from creditors like the Gulf states and China. And then there is the rest of EM. There is the investment grade portion and the double B portion of the EM asset class. Even there's a lot of diversification and differentiation, both in terms of the balance sheets as well as how these economies are coming out of this COVID and growth cycle.
Do you look at this as country by country or by asset class or even subsets of asset class?
You have to look at all, unfortunately. I don't think EM is a one-size-fits-all in terms of the framework or model that you need to use. And so, really thinking about asset classes and regions makes a lot of sense right now, as well as countries that perhaps are going to benefit more secularly from the nearshoring and structural shifts that are occurring both in the global and macro playing field for EM.
Lubin, I was reading this morning all of the rhetoric, the fiery rhetoric coming from the Chinese Communist Party, coming from leaders talking about the increasingly fractious relationship between the U.S. and China. I hear the same coming from a lot of U.S. officials. What's the investment consequence of this? Because right now I'm still seeing a lot of people say Chinese debt, Chinese equities, they're a buy.
I think the main investment implication from this is to really think about EM in terms of the various centers of global growth and drivers of global growth. For EM as a whole, this fractionalization that we're seeing much more of from the US and China trade relations and geopolitics is really going to be a headwind for many countries within the asset class. Slow globalization, as the IMF has coined the term, is not a positive for the EM asset class as a whole. Having said that, there are areas that are going to be growing and perhaps benefiting from this. Countries like Mexico, countries like India, many other smaller emerging markets that perhaps have a niche in particular parts of the supply chain. And so for the EM asset class, I think the investment implication really is to start from the bottom up and really focus on country by country selection in terms of really thinking about the investment opportunities that are out there.
Specifically with China, I think about Mark Mobius, the emerging markets investor who complained that he had some money in China that he couldn't get out because of all of the red tape that he had to go through to bring the money out of the country. In your view, is China not uninvestable, but increasingly a fraught investing proposition that perhaps isn't recognized in pricing currently?
Well, I think that, looking at the fixed income opportunities in China over the cyclical horizon, we are a bit more cautious given the opportunities elsewhere within the fixed income world as well as within emerging markets. So if you're looking at the level of real rates, really you're getting better opportunities elsewhere, whether it's Brazil or even Mexico. If you're looking at currency plays, perhaps the CNY is not the best play right now given with outbound tourism, you may see capital outflows resuming. So I think that from an investment perspective, there are more interesting opportunities from a risk-adjusted perspective elsewhere within EM.
Lupin Rahman of PIMCO. Lupin, thank you. On EM, China, and whether it's investable or not, when you saw the reopening, I think everyone, Lisa, piled onto the idea. It is now. And we saw Chinese tech stocks absolutely rip. You pointed out yesterday off the back of this, and not my language, other people's, disappointing Chinese growth target. Let's call it modest at 5% as this economy snapped back. Does that open the door then to a little bit more fiddling, some regulatory moves from the Chinese leader?
I had to wonder about that, especially as we read about some of the changes to the structure of the government overnight. They took some people out of sort of the main bucket, and then they took them and put them into higher regulation for the financial industry, more data